There's Frank.
Okay.
Calling meeting to order. Dana, would you call the roll?
Mark Nonick.
Here.
Carl England.
Here.
Jack Prothero.
Here.
Terry Cogy.
Here.
John Satry.
Here.
Diane Fladmo.
Here.
Maggie Peterson. Here. Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Sales. And Representative Hamilton.
Here. Thank you. Now is the time when we remind everyone that you're being recorded on video and audio. Just in case you could say something, turn around and say something that doesn't work. Followed by the time for public comment. Anybody who has anything within the jurisdiction of the board that's not on the agenda wishes to speak about it, may come forward now. Seeing none, we will move on to the introductions. We have two people to welcome today, starting with our new executive director, Dan Villa. Welcome, Dan. And our new member, Jim Edwards. So I thought maybe since we got two new people, and I know you know everybody by now, but perhaps we ought to do a little brief bio introduction for everybody going around, starting with Representative Hamilton.
I'm Representative Jim Hamilton. I represent House District 61, which is on the east side of Bozeman in Gallatin County. And this is my first term in the House running for re-election. And in this liaison, it was mostly for Jim. Everybody else knows this already. But in the role of liaison, there's one person from the Senate, one from the House, one Democrat, one Republican. So I represent the Democrats.
I'm Terry Cogy, and we were just talking, I was in state government for 20 years and then PA Davidson for 20 years.
I'm John Satry. I live in Helena. I was a partner in a company that did design and construction, and I'm retired.
I'm Maggie Peterson. I'm soon to be retired again for the second time. I'm on the Imperial board, and I worked at Montana Tech for 29.5 years as a vice chancellor for admin finance.
I'm Dana Chapman. Oh, sorry. Go
I
ahead.
just want to say nice to meet you.
I'm Dana Chapman, board secretary.
Dan Villa, Executive Director. I'm Mark Nonig. I'm an attorney from Billings. I also spent 8 years in the House of Representatives, and that's probably all you need to know about me. Carl?
Carl England, I'm an attorney from Missouri.
Jeff Greenfield, I'm a member of the Teacher Retirement System Board and the liaison on that board for this board.
I'm Jack Prothero, I'm a retired banker from Great Falls.
I'm Diane Fladmo, representing labor with MFPE.
And you?
Excuse me, well, Jim Edwards, and I'm also joined the ranks of being retired for the first time, 2 years. I spent my business career, well, I spent 7 years in banking, so for those of you that are bankers, I spent a little time in banking. I grew up in Miles City in eastern Montana. Was a closet bobcat, but I'm out of the closet now that we're reasonably competitive. And I was in the insurance business. I owned a employee benefits agency called Mountain West Benefits, and sold that to a company out of Cedar City, Utah 4 years ago called the Levitt Group, and spent 2 years working after selling and then retired 2 years ago. My wife is Sheila Hogan, and Sheila ran the Department of Admin, is now DPHHS. So it's I much like being a kept man versus a contributing guy. So, and I'm excited to join this board. I can tell already it's high quality, and I know that the work that's done here is just really important. So thank you.
Welcome. Thanks again, and welcome. Again, you can't resist that story. I was campaigning in Miles City, and I didn't have my wits about me. I was following Denny Reaver. Some of you probably heard this story. It's not a big one. You know my story. It kind of. So anyway, he gets up and he says, "I'm Denny Reaver and I'm a great," and he gets kind of some response that's positive. That's great. So I get up and I go, "I'm Mark Hogan." And boo! I go, "Wait a minute. I was a bobcat before I was a grizzly." I'm thinking, I'm trying to save myself. Nothing. So if you're in Miles City, I would have I don't think you'd be a closet Bobcat. Seems to me you'd be one to be right out front there.
I live in Helena now for 12 years.
Well, they're not that good, I mean. You're on tape.
All right, let's go
Turn the video off for a minute.
Go to committee reports. We'll start with the audit committee. John.
Thank you, Mr. Chairman. The audit committee met today, and we received several reports. The first was on regarding financial statements. The Board of Investments made response to Whipley's SOC audit. If you remember, there was an exception that had to do with access. We made a response that will be included in the final SOC report, indicating that we took action immediately to comply with the recommendation that was made. Julia reported on fiscal year 18 statements. Draft statements were given to DOA on October 1st. We are providing, as GASB requires, an MD&A in the statements this year. And we have coordinated our statements, our draft statements, with the GASB consultant to make sure our statements are in compliance. He currently believes that they are, but is still reviewing. And we are in the process of doing peer reviews as well. Preparation of the annual report is in process. Regarding STIP, we received a report. If you remember, there was a situation with Yellowstone County where there was a question of some fees that we had to pay or that we incurred because of an action on Yellowstone County's part. That process is resolving positively, it sounds like. Julia reported on the STIP web portal transition. It is in process. The start date for this will likely be the spring sometime of 2019, although that's still a moving target, and there's a lot of education of our users that needs to take place. Our resolution status, if you recall, we had several agencies that had not filed their resolution with us so that they could use STIP. Julie reported, along with Jeff, that we are now 100% of agencies are signed up. Dan reported that there is some issue that he is aware of and working on regarding a portal intercap site, and will be bringing us more information in November. Mr. Chairman, that's the audit committee.
Questions about the report?
You don't have any action items on that?
No action items.
All right. Carl, you're up on human resources.
We had a very brief Human Resources Committee meeting, not much on the agenda. We do have some staff changes. Mary Nowak, our network administrator, is retiring, and we say thank you to her for a wonderful career and good luck in her retirement. Oh, there she is. Thank you. And Maria Crippen, who's not in the room, is leaving us to take another job. And a lot of us who dealt with Maria, we know what a wonderful person she is. We're sorry to lose her, and maybe we'll get her back. So, thank you to Maria. And then we have a new staff person. I'd like to, Mr. Chairman, if I could call on Louise Welsh to introduce her.
Thank you, Mr. Chairman, Member England. I'm pleased to announce that we did hire a new bond program officer, and it is Tam Nelson. Go ahead and stand up. She comes from us from Seattle. She originally came from Butte, and she was in Seattle for about 15 years working for the same company and in a fast-paced surety bond firm at that time. So she came back home for family reasons, so we'd like to welcome her in.
Well, welcome.
Thank you.
That's it from Human Resources.
Any questions for Carl? Okay. Thank you very much. Let's go to TRS, PERS, what's my approach? Maggie?
Oh, We have not met since our last board meeting here. We are meeting this Thursday. However, I wasn't sure if I had indicated that we finally have a full board. Sheila Wilson came back to the board, the Impera board, and we have Robin Driscoll from Billings now on that board. So it's nice to have a full board that we're working with.
Okay.
We have not met as well since our last meeting. We meet on Friday. And so next time we'll have a report.
Great report.
Thank you.
We have our actuary coming, that's why we got there.
Good.
Okay, thank you. So I think that brings us to the liaisons. That's Representative Hamilton.
Thank you, Mark. We are during the quiet season now. All of the interim committees have really finished meeting, and with the exception of Revenue and Transportation, which meets one more time to approve the revenue estimate. The one thing that I can see that came out maybe since the last meeting that might be of interest to the board here is that Local Governments Interim Committee proposed 3 committee bills which will come out of committee focused on affordable housing. So one is called Workforce Housing Credit, which I don't think will involve any board money in that case. Coal Severance Trust, I got this right, so Coal Severance Trust Fund Housing Loans, which looks like would empower, there would be the ability to make up to $15 million worth of loans, which I guess would affect the portfolio a little bit. And then the final one, Affordable Housing Grants, which doesn't appear to have anything to do with support.
Is that set up for the Board of Investments to do those loans? For the, do you know?
I don't know the answer to that.
So it would be similar to the Veterans Home Program that currently exists, and I think that's doubled twice since inception. Senator Edwards carried that. I don't see these getting much, I don't see a lot of legs under these. Affordable housing has been an issue for a very long time. From our perspective, it's a question of return and how much of the assets will we divvy up between that particular asset class or something else. So we'll probably...
We do the Veterans Program here, don't we?
I think, yeah.
Yes, we do the Veterans Program here. There's 40 million allotted to that program, and essentially we're out of funds. And I did meet with 2 of the people on the residential program. That's for low-income housing. So it'd be used in conjunction with low-income housing tax credits. And they just briefly told me the amount. And they were looking at kind of mirroring the Veterans Home Loan Mortgage Program with this program.
So would you need to be doing the qualifying, or do we turn that over to the Board of Housing?
Board of Housing. It would be just like the Veterans Home Loan Mortgage Programs. They would administer it, and we would fund it.
So,
tax trust fund.
Any questions about it? Thank you.
That was all I had.
Okay, that brings us to Executive Director reports. You're on. Okay.
The infamous tab 2, you have former Director Ewer's report. Most of the items we discussed this morning. There is a write-up there on the properties. Several board members asked about that at the last meeting. Happy to answer any questions you may have about that. The only thing I would add, I'll be in front of the State Administration Veterans Affairs Committee. We're actually trying to figure out the timing because their meeting coincides with our November board meeting. So we'll figure it out, but that is my report for this month. You do have a crib sheet in case there's any questions on that behind the tables.
I was under the impression that we might have a kind of great quantity. But Terry's one asked for it. Were you satisfied with the report on the investments of the?
I think we've got what we're getting.
Well, it may not be so much.
We have to be satisfied.
I think this is where it stands.
Okay. Well, it's almost a foregone conclusion anyway. I think we're going to keep the building, but.
I I'm interested how the lot is providing above market returns, but, you know.
Oh, this one?
Yeah,
Oh,
but, you know, whatever.
For a lot it is. As soon as we sell it, it will be comparable to market.
Yeah.
Right.
So, all right, thanks. And you said the monthly snapshot. Anything else? Did you have anything else? Any questions on the executive director's report? Board member training session in Portland, Oregon. Who's going to do that? Who's maybe using?
I think it was meant to be like just a kind of a recap for the folks before that went to Portland.
Okay.
Since
I heard you say you were going to do it.
No, I heard Terry say that.
Oh.
She's going on vacation from
I think it was excellent, and the group asked us what we would suggest be brought to you from it, and that's what you're going to hear later this afternoon, a recap of it. What I said in it, when they, to thank them, I've always been impressed by RVK, but being there, seeing their staff, seeing their process, I was even more impressed. What I thought was particularly interesting was how they brought in new grads from the local universities and brought them up through the system. And boy, you could just feel the intellect crackling in some of those rooms. And they just, it was felt really real and like what we get, the number of people that are behind it, what they're doing. It was very impressive. I was glad to go.
I like that. I think like cracking.
Well, it was.
Don't tell him.
a good thing.
Don't tell that to Jim. Don't tell that to Jim Boyko because it will be one of his metaphors.
Oh, we kept counting on his metaphors even there. We did it for you, Mark.
Okay, we're going to some more questions about it. It was good. How long did you spend there?
Just the one afternoon, just a little bit of introduction, and the next day till about 2 or something. It was interesting. It was very educational. I personally learned, they went through different things like diversification, active versus passive, which we know here, but they kind of reiterated some of the things that we needed to know, the important things. They talked about capital markets and stuff. I just thought it was interesting overall, and I think every new board member should go out there and spend a day.
Who all did, just 2 of you?
Jeff
and Diane.
It was quite interesting to be there. One of the more interesting things to me was to watch the number of outside individuals coming in to kind of be vetted, to hawk their wares, so to speak, to show that they really had a good product, that they would be somebody that would be recommended by RVK to us, to our staff. It was really interesting to see the suits walking in and looking nervous. But it's good to see there's a lot of work behind the scenes, for sure.
I appreciated seeing their commitment to Montana by virtue of the attention they paid to us and their obvious willingness to come to Montana to board meeting and how closely they work with our staff. They spoke highly of the staff as well, which I appreciated. I also liked the no conflict of interest in the structure of this firm, so that it was clear that they had the client's interests at heart, more than being diverted out toward other interests as well. So I enjoyed my time as well, and I would encourage others to take advantage of it. Thank you.
Just one other thing. The other thing is, what I appreciated is they had several people speaking on the operations and how they did certain parts of it, like the research part, the investment operations, that type of stuff. It was really helpful for us to see how the workings of RVK.
So was it the 4 of you, or was it, were you among a group of other people? Was it just a special thing just for the 4 of you? Oh, that's pretty cool.
It was. It's amazing.
It's an amazing operation. I was impressed.
Mr. Chairman, I tried to report the voucher we prepared for them for bond was not used, so it will be removed.
Oh, cool.
They took cash.
I'm not sure I understand that.
Bail.
Oh, bail.
Yeah.
Thank you, George.
We're learning more about the type of law you practice. All right, I appreciate it.
But it was close.
A little slow on the uptake. All right, I guess we're on to new investment commitments. Right? I didn't work us through a break, did I?
No.
Good morning.
Morning, Chairman, members of the board. I'm Emily Kovarik, an analyst on the privates team. Today I'm going to talk to you about our recent commitment to HKW Capital Partners 5. You'll find this at the start of tab 4. We recently committed $40 million to HKW into their latest fund. We have, prior to this, we committed to the previous fund, Capital Partners 4, at a level of $20 million. HKW is a high conviction manager for us, and as you know, as part of our pacing studies, we've begun doing higher commitments to our high conviction managers in an effort to help trim our portfolio into a manageable number of names. And that's why you're seeing the upsize in the commitment that matches our conviction in the manager as well as matches our pacing that we're putting forth in our portfolio. HKW is a very stable firm. They've been long tenured. They're a very reputable partner with the small companies that they target. They've achieved near top quartile returns in the last 2 funds, and they focus on business services, health and wellness, and infrastructure, but they are a generalist in that they will target companies at the right time of the business cycle as they have done their research to prove out what they think will be most profitable for their investing strategies. One of the things that we really like about them beyond their great reputation and their strong culture is they have a leverage discipline that's more conservative than other lower middle market buyout managers. And as they go into most of their purchases at just 50% of debt or less. They focus on deriving value creation in the fund's portfolio by building out the earnings growth of those companies. And again, one of the other items that makes them unique is they work in many markets that other buyout managers don't. Their sales team, their acquisitions team spends the majority of the year on the road, and they're the type of team that literally comes and knocks on the door, shakes the hand, meets these individuals in their mid-sized cities. So they're focusing on areas that perhaps some of our other buyout managers don't, because they're willing to go to the mid-sized cities, such as Midland, Texas, parts of Illinois, New Jersey, North Carolina. They also have a focus of looking at Canada, where they've had some successful investments. With that, I'll open it up to any questions that you may have.
What do you mean when you say the right time in the business?
So one of the things that they do is they've done distinct studies of the different business cycles. So for example, just notes here. So, for example, they avoid investing in capital equipment and OEM manufacturing late in the cycle. But they will invest in those types of companies early in the cycle because as they've done studies of the different manufacturing sectors, they've determined that some are more poised for success at the type of the cycle of their business, depending on what's going on in the economy. So as an OEM manufacturer is early on in its growth, that's when HKW would want to invest. And as that industry itself is doing very well, but as any business type within U.S. markets and Canada will go through cycles of when it's profitable or not profitable to invest. So they're very attuned to that.
Emily, when you were talking about the focus, business services, health and wellness, and infrastructure, is the infrastructure services, is that related to health and wellness? Or is that, what is the type of infrastructure that they invest in?
Let's see. So, Crane Rental Corp, for example, is a company that they invested in one of their last funds. So it's a company that literally rents out cranes and services the construction industry that builds up infrastructure projects.
Okay, okay. And then I had a question, how do you qualify as a high conviction manager within the Board of Investments?
Great. So as part of our team building its view of managers, it's consistently an evolving process of characteristics that we look at. But one of the things, so there's many different qualities that we consider, but if I could offer a few as an example. High conviction managers are ones that we feel have remained true to their strategy and demonstrated that their stated strategy at the beginning of our commitment to their funds, that they have maintained that strategy, they've maintained discipline throughout their strategy and continue to deliver on the results that they targeted at the onset of the investment. We look for ethical behavior. We try to do our best to verify that, not only through our interactions personally with the manager, but by doing reference calls and talking to the companies that they invest in, talking to the people they sell to, and making sure that this is a manager that has a very solid reputation, that doesn't pose a headline risk for MPOI. We also are attuned to wanting to see that GP, that manager, is aligned with the investor's best interests, that they are making sure that they are taking, if they want to earn carry, that they're doing so upon successful completion of exits. We typically like to see in a European waterfall where they've gone through the cycle of the fund and they're not earning their carry till the end of the fund. We also like to see that they have themselves personally invested in the fund, put forth at least 1.5, between 1 and 2, but we typically like to see 2 and above on a GP commitment to a fund, because that means that they're putting their money where their mouth is. They are investing right alongside of us, and they're dedicated to the success of that fund. That's an example, a sample of some of the high conviction attributes we look to. Thomas, do you have anything you want to add?
I think we look for a cultural fit too, that the culture of the firm is as stated and aligns with our views. So there's a lot of intangibles in there as well.
Okay. So it's more of there's not a list of high conviction managers. It's more of a feel for those that are existing?
Well, we actually do, internally within the team, we are constantly evaluating our managers and trying to categorize them into 3 separate buckets, basically. Our high conviction, mid conviction, and low conviction. And those viewpoints on those managers are being evaluated and assessed along the way as we interact with those managers, as we have visits with them, as they report to us on what their results are, how they're sticking to their strategy, not sticking to their strategy, asking for fund extensions when they said they wouldn't need any at the beginning of the fund, things that we like to look at as we evaluate the relationship over time.
Thank you.
Really quick, how much weight is there placed on the manager's performance in becoming a high conviction? Maybe this is a 2-part question. And the second part is that you folks have a way of evaluating your own rankings of high conviction, mid and low, and how successful that's been.
So to answer your first question, remind me again.
First one was about performance of the manager.
So we look to performance, historical performance, as an indicator of what that manager is capable of doing in the future. But we try not, our judgment isn't based solely upon what past performance is, although it does give a good view into how we think they will perform in the future. But what we really try to do is look at their strategy, find which aspects of what they do make them unique, give them an edge in the market. Are they looking at, for example, this manager, looking at buyouts in a different lens than other managers that gives them an advantage above other managers we may have in the portfolio? So we really try to temper that view of the historical performance and try to take a forward-looking view on where we think they can take that. Definitely just wanting to assess that that manager has the ability to consistently evaluate their strategy throughout the course of the fund. You know, these are long-term commitments. These are, 10, 12, hopefully not beyond that in the time that we're engaged with that manager. And markets can change. So we definitely want to look at that historical performance, but consider what that manager knows, the intellect of the team, the dedication, the drive of those individuals on wanting to deliver solid returns for their investors and their commitment to doing so. And so secondly, again, your question was about how is our process for establishing those views on the managers
No, it's
evolved?
more about your, do you have a process of evaluating how successful your designation of high conviction UMO is?
We have a process in place. Quarterly, we meet and talk about each of our asset, we alternate and we talk about our asset classes on a biannual basis. So one quarter we'll talk about natural resources and real estate managers. The next quarter we'll talk about private equity managers. I suppose in doing so, we're evaluating not only what our initial assessment was, but then how things have changed over time. Many of our managers that we started out with when we started our private investments portfolio, we did fund of funds. That was our entryway into the marketplace. So, some of those relationships, because those funds they were high conviction at the time when we went in, and they've definitely delivered solid returns for us over the years. But as we've changed strategies, sometimes those investments with those managers become lower conviction because we're not aiming to go down fund of funds path anymore. But Ethan, would you like to offer
To
any
answer your
additional-
question specifically, there is no industry standard that exists that we can employ that involves us measuring what is important to us versus what is important to other people and how those two interrelate. So it's an apples to apples. What's important to us is not necessarily what's important to us about certain managers may not resonate with other similarly situated investors, just to put a very fine point on it. So to Emily's point earlier, it's a constantly evolving process, and we evaluate it on a regular basis as part of our day-to-day jobs.
Just jump in real quick. Is the question really, you've had high conviction managers, you've had, average, whatever the categorization you use. If you look back over 10 years and said, for the ones we rated high conviction, they outperformed by, their performance was 20% better than the,
right.
Is that your question?
Right. Basically,
we
you
can
can
do that.
designate high conviction and you've given them more money, so therefore, hopefully they have more return based on what's important to you here, not compared to anybody else.
Performance is one thing, and that's absolute for sure, but that's not everything that's feeding into what makes them high conviction for us. And I'd say for those managers that we designate high conviction, it's very clear in the performance, in the relationship, in the transparency, in the communication, but how we measure that is not scientific.
Ethan, maybe I can add that at time of investment, all recommendations are assumed to be high conviction. We wouldn't make an investment in anything in mid conviction or low conviction. So it's not really we can't really do a look back at all of our mid conviction recommendations. They're all high conviction. They're all, A, top quartile managers. I think that should be assumed by the board, that we're not going to do anything substandard and put in a portfolio at a smaller amount. We've had the discussion on the team, do we do a smaller amount because some of us are unsure of the strategy or the team. As a team, we've decided it's only going to be the best managers, and if we're going to commit any amount of money, we need to have high conviction.
So do you rank them after we've invested with them and had some evidence of their performance? Is that
Yes, and that's what I was speaking to in the biannual evaluation of every manager. As Michael said, all of our managers, when we commit to them, they start out high conviction. But because these are long-term relationships and long-term funds, things can change over the course of time. Perhaps key personnel of that firm happen to depart, or perhaps, unfortunately, this happens sometimes where someone passes away. And that could change our conviction on whether that firm can pick up and go where they need to go. So over the course of time, we'll adjust our conviction rating as necessary, but we're very proud of the many high conviction managers we have in the portfolio.
Emily, I just wanted to say I appreciate the terms on the back. And also on the front where you separated out the commitments, so it was easy to find. This was easy.
Thank you.
One question, however, on the front, just because I'm new, TBIDITDA.
Earnings before income taxes, depreciation and amortization.
Thank you.
It's actually in the back. I thank you for that. I thank you for that.
Yes, interest, that's right. Interest taxes.
It's in my very back. Thank you.
Oh, you mean, okay, yeah. I just didn't see, I knew it was in the back, but I didn't see where it was. Okay.
Thank you.
Is there any further questions? I think you're good. I'll jump to the next new investment board. This is Chickasaw Master Limited Partnership, publicly traded midstream energy manager. You heard me say publicly traded. We have a private markets team. But this will be part of our natural resource asset class. If you recall the August board meeting where Emily and Terry were talking about the 4-quadrant view in real estate, we're trying to employ a similar approach in our other asset classes. We'll be trying to cover the public side as well as the private, as well as equity and debt. So this would be in the natural resource portfolio, but it's a publicly traded strategy. Midstream energy, most of you probably know what it is. It's everything in between the drilling, exploration, pulling oil and gas out of the ground, all the way to the end user, everything in between, your pipelines, your processing plants, shipping, transportations. That's what these gentlemen, these folks invest in. We started out looking at the universe, about 30, 40 managers in this space, narrowed it down to about 12 or 15 that we, as a team, looked at a closer look, a deeper dive. We have 4 folks here in Helena visiting us, and out of those 4, we selected Chickasaw. Chickasaw stood out to us. One of the things that Emily mentioned as well, it's a 100% employee-owned firm. We'd like to see that in terms of alignment with our interests. There's no outside party, no broader corporate balance sheet that has anything to say with the firm. The strategy itself is a smaller in terms of assets under management. We like that fact because the midstream energy space is a relatively small marketplace. So if the strategy becomes too large, we end up being a passive investor and buying the overall universe, and we're trying to avoid that. So Chickasaw has a smaller strategy, a high conviction concentrated portfolio of about 20 millions. We really like that. One note to the board as well, you see the management fee on here, 80 basis points on all assets invested. We were able to negotiate that down from the originally stated 150 basis points. So we credit our efforts, our team efforts to that success, if you will. That was a big jump.
That's a big jump. I mean, how does that work?
So the Chickasaw actually admitted that the 150 basis points or 1.5% on invested assets is a legacy fee schedule that they haven't gotten around to change yet, and it's noted as negotiable. But I've called them out on this too. I'm like, well, this is, it's going to deter a lot of investors not to invest with you if you have that big number out there. And traditionally, I've seen from other groups that invest in Chickasaw, they were able to negotiate that down pretty significantly. The 80 basis points, almost half of that, is better than what I've seen in the past from other investors. So we're pretty proud of that.
It may also be worth noting that we negotiated a most favored nations provision in such that if a similarly situated investor comes into the strategy to the firm post our entry at a lower rate, we will get the benefit of that going forward as well.
What is a similarly sized investment?
Similarly sized investor. So irrespective of whether they're an endowment, a foundation, a municipality, another public pension fund, a sovereign wealth, what have you, if they come in around 40 million at 65 basis points, for example, we'll get that fee on a go-forward basis.
So they used you as the floor then?
No, I don't think so.
Really, no. What do you mean, no? If someone else tries to
They
negotiate
have-
below you,
yeah,
they say,
well-
well, look, we'd love to do it for you, but
Maybe
we've
talk about-
got this Me Too clause and everything.
Maybe talk about the anchor investors that help establish the strategy and how that is viewed within the industry.
Yeah, so this is, so we're not the trial and error here. There are other investors before us in this strategy, another public pension plan that have negotiated that clause already before we even started looking at Chickasaw. So that was in place, but we always include that in our subscription documents, in our contracting. That was actually, the other investor was at $250 million, if I recall correctly. They're at the exact same fee structure as we are with our $40 million investment.
So sometimes, Carl, an investor for taking the initial risk when a team comes together initially without having any assets under management, someone will take the risk of funding this new team, if you will, and it's early on, they need to get, their business going, and so as a result of that, they have leverage, and as long as they can arrive at a fee that's enough to keep the lights on, if you will, they'll give them a much lower fee and honor that through time, and that's an example that exists here. I believe there were also a few early relationships that were brought in, maybe vis-a-vis a consultant or another sort of private banking relationship where they aggregated a bunch of clients into a very large number, 200, 300, 400 million, and they'll give that a more beneficial fee structure and treat them a little bit differently, obviously for size, but it's a bit of a different relationship. So there are investors in this strategy that have a better fee than us, but again, to my earlier statements, I won't totally repeat myself, but we're set up to benefit if that dynamic should manifest at some point.
Maybe an additional comment or two. One, we would never have done the 150 basis points. Right? So fees are important, right? As well as other things may look, fees are critical at the end, and not just in this situation, all situations. So, and the second thing, it's good to get into some of these details, but this situation, these terms, the reference to MFN in a contract is not unique to this situation. It's something that we employ with all our public market managers as we go forward. So it's the same process that Randy and team and with the help of Mike and Tim and investment operations that we're regularly doing, and it's a critical part. So this is a case that worked out well. We identified a manager, a strategy that we thought had the right team and execute to kind of reach our goals and had a fair price to do so. And so, but it's important to understand it's consistent what these guys and the broader team does on a regular basis across our portfolio. It's good to highlight this situation that was not unique.
Thomas, I'm not really used to seeing, and maybe it's just because I miss it all the time, in these briefs, reference to a benchmark. How do they use a benchmark, or what's the...
So again, the format of this board brief is a little bit different from what you're used to seeing from the private markets group, since it is a publicly traded strategy. Publicly traded strategies traditionally use a performance benchmark to compare themselves to and to help us judge the performance in relative terms. Chickasaw is not concerned with the benchmark listed here, the Alarian NLP Index. They're a benchmark agnostic manager. They're really trying to generate total returns for the investors, us. The benchmark, the Alerian MLP benchmark is the most widely used, broadest benchmark in this space, and most managers that are operating in this space, if they come into a portfolio, investors like us have to put some benchmark there to be able to compare relative terms the performance. That is the stated benchmark. We are not too concerned about Chickasaw over underperforms on a quarterly basis. We're investing with the long term in mind. We're hoping that they add value above this benchmark over 3, 5, 7, 10-year cycles. But at this point in time, it's really more a gauge of what the overall market would have done, and we're trying to outperform that with this active strategy.
But this is not our benchmark. This is their benchmark.
This is a public benchmark, just like the S&P 500 or a Russell 3000 that you see in public equity portfolios. And Alerian, Chickasaw would have listed that as, yes, we use that as the benchmark, but they're really not trying to manage that portfolio in accordance to that.
Thank you.
Any other questions at this point?
Thank you.
Thank you very much. So right to
Since we're a little ahead, I plan to keep going until noon, and I can just click yours in the middle if that's okay.
Good morning, Chairman, members of the board, Member Edwards, welcome. I'm Mike Pettit, Director of Investment Operations, Tim House. Also within operations, we're presenting to you today the proxy voting for our managers and the policy as part of the board's 24-month systematic education plan. I'm not going to follow this exactly, but I'm going to give you an overview in terms of what the process is. But as you know, for our separate account managers, where we actually custody the assets, not the funds or the ETFs or anything like that, or state custody, for those stocks at annual company meetings, that's how they take care of a lot of business for those company meetings. They have ballot measures, and through a proxy process, we don't have to be present. We vote those proxies, as part of our ownership of those securities. In terms of our proxy policy and our process, we delegate that authority out to the investment managers to vote those particular proxies. The investment managers look at that as a fiduciary responsibility. We look at it as a fiduciary responsibility as well. So we have a process that's set up in terms of monitoring those particular processes. And it really starts initially with when we hire the manager. Part of the process of contracting with them, we actually contract with them and say, okay, we delegate proxy authority to you. We ask them, provide us your proxy voting policies. Let us know if you use an outside provider, which in a lot of cases, the two biggest providers in the market would be ISS or Glass Lewis as proxy advisors. And so they tell us that up front. On a quarterly basis, we receive, on an annual basis, we get proxy voting policy updates. We also get any reports from the managers, whether or not they've actually voted something differently than their policy stated. And then on a quarterly basis, we get information from the managers as well in terms of the voting that they've done.
Mike, what instance would they vote different than their policy?
Well, I think it just depends. So, for example, you might have one firm. I think we have an example in here within the body of the paragraph, T. Rowe Price. They might have a growth mandate. They might have a large cap mandate. And those managers might look at those particular mandates differently based on their policy. So typically a policy that the managers will follow is going to be one that is designed to maximize value to the investor, ultimately us. So whatever fits within that particular strategy, they might have a difference of opinion on. So if you look at some of these proxy voting services, there's actually lots of different ways to vote. And I was looking at kind of Glass Lewis's policies, and they actually have a general policy. They have one for public pensions, they have one for unions. The unions might follow AFL-CIO guidelines. They have a Catholic policy. They have an environmental, social, and governance policy. So depending on what your view is, but our particular managers are looking to get the best return for them, because that's basically our mutual goal is a return for the pensioners. So they will typically follow that. But depending on the situation, they could also look at other things that might occur. Like, for example, in some of the international markets, there might be share blocking countries where they can't vote during certain periods when they trade the security. They don't want to give up that liquidity. And then there's other situations too where they might decide not to vote a security because it's a public, it becomes part of the public record and could impact the value of the stock. Does that answer your question? So again, we view it as a plan asset. We view it as important. It's part of our fiduciary responsibility, and the managers feel that way as well. So as I mentioned, on an ongoing basis, we receive information from the managers and ensure that they're voting proxies. And then if they decide to vote something, we ask them that's different, then we ask them to report that to us as well. As I mentioned earlier, ISS and Glass Lewis are two of the biggest providers, proxy voting providers in the industry. So there's two ways you can vote a proxy. You can vote it yourself, go up on the website, sign up and vote it yourself, or you can actually reach out to ISS or Glass Lewis and you sign up for their service and you follow their general template. So you pick one of these templates that I mentioned earlier in terms of what their policy is. And so a lot of managers will set up proxy governance committees made up of different people within the organization. And if a particular portfolio manager for his strategy wants to vote contrary to what their general policy is, that decision is vetted throughout that corporate governance policy. And then finally, we're going to move over to some of the particular cases, like on pages 2 and 3 of the report here. We've got the ability that if we decided that we felt strongly enough about a particular issue, all of our managers give us the ability to dictate how we want them to vote on a particular issue. We haven't gone down that path in the past, as far as I'm aware of in recent history, but they do allow within their proxy policies to take client direction in terms of particular votes. We talked a little bit about the Proxy Oversight Committee, and then on page 4, here's just a list of some of the providers. You can see in a lot of cases our managers will use, some will vote the proxies like AllianceBernstein. They use outside advisors or the proxy service providers as advisors, and others, as you go down the list, they use ISS, and they'll use Glass Lewis as well. Yes.
So, you said they would allow you to, or us to make recommendations on how we want them to vote and stuff. So are you guys notified of every one of these votes that's coming up? Is it?
We are not.
So how would you know which ones you want them?
Well, I think that would be a change in terms of how we handle the process. Right now, our goal is to say, okay, we're going to delegate to the manager, and we're going to have the manager make the best decision on how to vote based on their opinion of that particular ballot measure as it relates to the company and ensuring that overall value is maximized for us and for their return and so forth. If we were to go down that path, it'd be something where we would need to become more active from a corporate governance perspective, and then generate opinions. And so it's there's a wide range in the industry. I think we take a pretty common path in terms of delegating that. There's other ways where we could do more in terms of voting the proxies ourselves, similar to the managers through a proxy service provider. And if you look at some of the biggest players in the industry, it's very interesting because they will hire corporate governance managers very specifically. they create a structure in which the manager buys very concentrated positions of particular stocks where they feel they can get a return by improving the governance structure. I don't want to say it's the opposite of diversification, but the goal there is to buy big chunks, put ballot measures on there, improve the governance structure, and get returns. So that's what we see from some of the largest public funds in the industry in terms of how they do that. So what we do is through the regular reporting from the managers on a quarterly basis, we also look at the actual votes, and we make sure that they're voting. We don't really look at their voting on their policy, but we want to make sure that they're voting. And if we see circumstances where they're not voting, we want to understand why. So if you look at the table on page 5, I'm going to have Tim walk you through this. This is actually a service through Broadridge. So Broadridge is kind of a unique company. They've got about 90% of the market. And they have what they call proxyvote.com. They have their online system. So 90% of the votes that go through the industry go through proxyvote.com or go through Broadridge. So they're the ones that, once the ballot, basically State Street sees our positions, and whatever we hold as of that proxy record date gets transmitted to Broadridge and proxyvote.com. The ballots are sent out to the managers then vote through Broadridge, and then what we've done is we've actually acquired access into Broadridge where we can actually run reports. So periodically we look at these, and Tim's going to walk you through the table here to kind of tell you what we looked at.
And this is just a summary of the votes that happened in 2017. You can actually go into detail about how each vote was voted, whether they were with management, against management. There, underlying each of these share votes is a lot more votes and a lot more detail. And so we can go in and look and see how a manager actually voted for something. One of the things you might note is shares not voted. All of those are non-US, so the share block countries that Mike talked about earlier, that instead of them pulling back the shares and voting them, they wanted the liquidity to be able to trade them during this period, which some countries don't allow you to do that. The totals down here are very similar to what we saw in 2015 when we presented this to you last time. There's no huge jump in anything. Characteristics are kind of the same with the non-US are the ones where the shares not voted. Mike was talking about active managers, I guess is what I would call them, but managers that actually go out and try to change the direction of the company. Iridian would be a good example of one of those. They're more concentrated. Yes, sir.
Tim, I didn't follow the share blocking. I don't understand how that works.
In some countries,
Political government.
that's a regulation for the country itself. They, if you were to want to be able to vote your shares, there may be some times when people will go out and actually just purchase the shares for a short period of time so they can vote them. In some countries, they don't allow you to do that. They say you've got, during this period that you hold this, with around the proxy vote, you're not allowed to sell these shares.
So a particular period of time or for a length of time that they can find?
I think it depends on the market. So if we look down in the kind of the footnotes underneath that, so these share blocking markets, they forbid the equity owner from trading company stock and exercising rights during the proxy time period. So I think that's really defined specifically by the market. I don't think it's an extremely long period, but I think a lot of the managers will shy away from those because it will restrict their ability to sell the security if they did in fact vote it, and then the market takes a turn or that particular company takes a turn. So those particular countries are Argentina, Belgium, Egypt, Lebanon, all the way across to Switzerland and Turkey. So a whole list of countries down there. The other thing too is if, obviously we participate in securities lending. A few meetings ago we presented securities lending to you. So if our shares are out on loan, the person that is actually the entity that's borrowing the shares from us, they
basically receive the right to vote the proxies. So that's another method that some borrowers or some activists will do, is they'll actually borrow the shares during the proxy period so they can vote for that particular issue. So when you look at this table, you'll see shares not voted. That's not included in the shares, on loan. So that's really related to, those markets where share blocking occurs, or
again,
you don't want that to become public.
Is that, just my ignorance here, but it's not like they prescribe, January to March. So it's like within X amount of time when you own it and try to vote it, or is that?
Yeah,
it's the proxy period.
It's during the proxy period. So usually there's a proxy record date that's basically whoever owns the security as of the proxy record date.
Okay.
You come entitled to vote the shares. I don't know the specific answer by country, but you've got the proxy record date, then you've got usually when the vote occurs. So there might be differences between the country. It might be a few weeks prior to the proxy record date.
But what they're saying is if you own it on this date, you can't trade it and vote it.
Yeah, if you own it during a certain time period, you can't trade it. So what that basically does is if they went in and voted it, and then all of a sudden something happens in the market or that particular securities, they're stuck. They can't sell it. So managers don't want to lose that liquidity. So in these cases, on the right-hand column, you'll see shares not voted. And Tim's done a lot of work to reach out to the managers, like Lazard. We spoke to them. We spoke to Acadian, different managers, and kind of tell them, a little bit about what you did in that process. Yeah.
So I saw the numbers that came through Broadridge. And then I reached out to a couple of the managers to find out, what are these shares not voted? What is the category here? Did you miss them? And the share blocking was, as you can see, it's mostly non-U.S. stuff or countries, and the shares not voted. So that was the common answer, was that it was during the proxy period. The time frame kind of thing is like a dividend payment, where there's an X date, there's, you own the shares up to this point, the dividend's paid, and then you move along. It's kind of similar to proxy share.
So when you put shares on loan, what's the motivation? What's the value that you get for your shares on loan?
Sure, there's a monetary compensation for us. Yes, so shares on loan is really separate from proxy voting, but what happens there is someone would like to borrow the security for a particular reason. A lot of times they might decide that they want to sell it short. So they will borrow the security. In exchange for that, we receive collateral. And that collateral comes in the form of cash or securities. Depending on the type of collateral, we then receive a rate of earnings on the particular loan, and that loan stays out, and until we sell the security or a manager sells the security, they have to return it on demand. Or the loan stays out until we decide to return the loan. So it's really kind of a monetary, we receive securities lending earnings. Our custodian, State Street Bank, lends the securities on our behalf to their borrower network, and then we receive a split of the income from that.
So we have the right, on our managers, to vote the shares, to say, we want to vote the shares. Is that right?
Yes.
So is that true? Do you have to tell a manager we want to vote all of the shares, or could you tell a manager we just want to vote the shares of the XYZ Corporation?
Well, I think if we basically have a form in our contract that says this is our proxy voting, this is what we want you to do in terms of proxy voting. And then we have two boxes. One is delegation to the manager, which we have checked. And then we tell us who you use for your third-party provider. We have the option, if we ever wanted to do that, of retaining proxy voting authority away from the manager for us. If we wanted to vote on a particular issue, a particular way, that would be something that we would likely direct the manager to do.
on a one-off basis.
Okay, so that was my question.
Yeah. An example of that would be a gentleman was a shareholder in Coca-Cola and would send us a letter on a fairly regular basis 5 or 6 years ago and encourage us to vote a certain way on Coca-Cola or against a board member. So we could at any time have gone in, as long as there was an open proxy, gone in and voted however we wanted.
So if we had a bunch of people, like the lone people that were here before, coming in and they want us to vote certain ways, that gets to be a hot issue, which it might be going forward. How do you protect the board from having to spend a lot of time on making those proxy decisions?
I think you have to develop a policy. How are we going to handle this?
So do we have one?
What's that?
Do we have one?
Yeah, and that policy right now is to delegate it to the manager to vote in the best interest.
So if they came in today, our answer to them is we're delegating that to the
We delegate that to the managers from a fiduciary standpoint. The managers vote to maximize value.
Okay, but and so Jack and I think along the same lines here, but you can, I still don't understand this. We could tell that manager, vote the Coca-Cola shares this way. And we would expect them to do that?
They would have to.
They would have to? Okay. So then the question is, what do you need a process by which we screen those requests?
That was my question. That's what I asked is, do we really get notices of all these proxy votes, which we don't?
Which we don't, because that's
We
delegated
wouldn't
to the
want it.
manager. Yeah, you can see by the number of shares. I don't have a number here for the number of meetings, but it's very, very labor intensive.
Right, I understand that. So what do we need, do we have, or do we, I guess my question isn't, do we have, I don't think, it sounds like our process is to say we delegate that. But if this starts to become more and more and more requests, do we need to think about a process by which we can evaluate those requests?
Absolutely, and we can definitely do that. I think, in my opinion, the first step would be that we would have to develop some type of a proxy committee here, and we'd have to develop some type of proxy-specific voting record. And a good starting point are some of these providers. Like I mentioned before, Glass Lewis has a public pension policy. So that's a template that says, okay, on particular issues, this is the way we're going to vote. On these issues, this is the way we're going to vote. And so what you do is, based on that voting mechanism, you can see, okay, this is how we're going to vote on this issue, but then if a particular issue comes up where Tim says we're receiving information from our public or folks from the state of Montana, and we decide, okay, let's look at this particular issue, and we decide as a committee, similar to how the managers have oversight committees, we decide, okay, we're gonna dictate to our managers this is the way we want to vote. The other way you can do this too is if you went so far as to say, okay, we want to vote the proxies. You know, that's kind of taking that decision out of the manager's hands. I'm not sure we're in the position to be making the best decision based on their particular mandates. But what you would do is you probably use a proxy service provider right here, adopt that policy, you tell the provider to vote according to that policy, and then back up to say, okay, on particular issues that come to our attention, we're gonna deviate from that template. And so there's different, like I said, there's different ways. Like if you look at a manager policy, it's really focused on maximizing shareholder value and return. Whereas a public pension policy, you know, here's an example that just kind of gives you a specific example between two policies. So the public pension policy, talking about board diversity, there's a bogey there where fewer than 30% are female directors for large cap companies, whereas the Catholic policy does not have at least 20% female representation. So there's just little twists to the, you know, you start out with the general policy, and based on your industry or your segment, you change that. So I think if we wanted to go down that route,
or we became more ESG centric and focused, we could look at this, either from a standpoint of directing the managers on a one-off basis, or going a little bit further, which would be more resource intensive in developing our own process.
Do we have the resources to be able to do that?
I don't believe we do right now to do that, but it's always something we can consider.
I want to clarify the legal relationship. So when you say we delegate the voting to the manager, we reserve the right to exercise our decision at any time on any.
That's correct, yes.
So, Mark, that's something like that.
Yeah, I mean, I was just going to, into the resource point, I mean, this is, particularly for funds of your size, this is definitely typical. You're investing in your investment managers because of their judgment. They're voting those proxies in a way that hopefully is going to maximize value for the stocks, and they know that, best. So, in light of the fact that you have scarce resources, unless there's a specific objective that you're trying to accomplish that you feel like is not being accomplished right now with this process, it's probably not the first place we would pick to focus in terms of making a change, particularly in light of the fact that, this is typically how it's handled, and it kind of makes sense that it's handled that way.
And you guys actually reviewed it before we put it on. If you saw anything that gave you heartburn or anything was a problem, you would reach out to me.
Yeah, we want to make sure that the managers are voting and they're exercising those rights. So if you look at the table again, we had almost 107 million ballots cast. Of that, 106 million were voted. That 8.6 million shares on loan is actually not included in the ballot shares. So we actually had a total of 125 million, but we deduct that out. And out of all of that, less than 1% were shares not voted, and there were specific reasons for that. And so we'll look at the biggest players and say, okay, Lazard, Acadian, why did they not vote these? And they came back and said, okay, these were share vote companies. They gave us specific examples, Switzerland, other things like that. And then, like I said, there's other situations where that proxy vote becomes public. So then the public knows the manager owns that security and could impact the price. So, what we try and do is make sure, number one, that they're voting. We look at any comments. I know Randy has, and the public equity team have their review process with the managers. So it's looked at from different levels.
Mike, how is the proxy voting process, how does it work for the large portion of our portfolio that's passively managed?
Those are voted by the funds. So the ETFs, the mutual funds, the commingled funds. We might own an interest in the fund, but we don't actually own the underlying securities. So the manager themselves, the portfolio manager, the fund company, will actually vote those shares.
And they're voted to maximize return on those.
Absolutely.
And nothing else.
That's correct. Unless, there are funds that are
right, unless
that are
invest
an
in
ESG fund,
right.
For example. They might have a different take.
Right. Unless we ask for a fund that's got a specific
component to it, yeah.
Right, or a specific orientation.
And there are specific funds out there that are based for Taft-Hartley, some union funds,
right.
or public funds where they have certain ESG guidelines. There are funds out there, but generally our focus is maximizing return for the plan.
And that would be the exception to the rule that we could tell them how to vote too. If it's a co-mingled ETF, something like that, that we wouldn't be able to change the vote to. Just custody that State Street.
Okay. No more questions? For you guys?
Well, in conclusion, we're just going to say that based on what we've talked about today, our recommendation is to continue the path that we're doing now with the delegation of the managers. If the board so chooses at some point in the future, we can reevaluate that.
Thank you.
Thank you.
Thank you. Okay, let's start with the private equity review. And
Ooh, Thomas, policy twice today.
Yeah, no, I just don't want to.
Priorities. The most important thing is the actual.
What's wrong? Yes, it's still good to have lunch. Thomas Weaver, investment analyst with the private markets team. I'm here with my colleague, Michael Young, investment officer on the student team. We prepared a private equity asset class. We call it a deep dive review. It's really a chance for the board to ask questions. Just on an annual basis to log you down on every single meeting, all of the intricate details. But we would aim to it's a conversational session for the board to ask questions. Really trying to get you on the road with 4 main takeaways for topics, if you will. I'm behind tab 6, just to clarify that. For one, the role of the private markets portfolio within the broader pension cap, and we'll try to give you a high-level overview at the beginning of the session, a look through of the portfolio. The second point is really the basing. That's an intricate concept, but we'll spend some educational time on that hopefully and make that very clear and easily understandable how we look forward in the portfolio, how we plan to move forward with the portfolio. And we'll touch on the current environment, not to rehash what Ethan did in our August meeting and the whole private, but we're trying to combine and link how we think the current environment is driving our decision making and how we see the portfolio going forward. And of course, we'll touch briefly on our investment process. That was some questions earlier today on that, so maybe some clarifying educational pieces on how that really works, the nuts and bolts internally with the 5% CIO Joe Cullen. With that being said, I'll take it away. Page 3, really looking at the role within CAP. As you're well aware, we're trying to build out this private equity portfolio to a certain size. We don't have a stated target, and you hear me say this a couple more times, and we're very grateful we don't. In the coming slides, we have a range of 9-15%, as you see here on this page. There's a certain number of other restrictions that we constantly monitor and manage towards. We're in compliance with all of those. I'm happy to report that. And we'll touch on these individual points as we go through the presentation. There's also a benchmark to John's comment earlier. We use the MSCI US Small Cap Index as a performance reporting tool. However, we're not managing to this benchmark at all. It's really just to see something, what we could have achieved in the public markets over time. It's really just to put something in relative terms.
Question. On the fourth bullet under total private equity and your range, the fourth bullet, I don't understand what I'm doing for the cash out of the asset class level.
So within the private equity portion of the portfolio, which is currently 11%, 1.2 billion of the total pool, we hold a certain level of cash primarily to have liquidity in that portfolio. These long-term relationships, and again, we'll go through some more details. We commit a certain amount of dollars to a manager, and then they will get in touch with us when they have the opportunity and the company they want to invest in. They will call that capital from us.
It's a drawdown.
It's a drawdown tool, a liquidity tool, exactly. Okay. Shouldn't be more than 5, currently around 2.5%.
And that's just because it's not doing what it should do. You don't have too much money sitting idle.
Correct, yeah, the cash portion is, we have a limit on that. You don't want to have uninvested cash that doesn't earn much or nothing, close to nothing.
And Joe, correct me if I'm wrong here, but we've always said minimize cash throughout all of our asset classes.
Each of our asset classes has a similar policy here. So cash is one of those asset classes. So if we wanted a lot more cash, right, we would put it in the cash asset class. And here it's meant as a convenience. All of the cash is invested. We don't have, all of it's invested earning a return. There's no cash under a mattress or in a desk drawer. It's all invested. And And it is for each asset class, we have an amount that allows us to handle flows in and out on a daily basis without doing a lot of moving around. So we believe, in this case, 5% or less of the overall private equity asset class, that's a fair amount. Some days we need to write big checks, and we want that cash to be readily available. We don't want to go through a lot of operational gymnastics to get the money in the proper account. But at the same time, we don't want private equity to own 15% of the overall asset class in cash. If that were a goal, we would just move it to our cash asset class. And so each of these asset classes, we want them to do what is the objective of that asset class. But it is consistent across all the asset classes. We have some constraint guideline to minimize cash, with the exception of the cash asset class, which is all cash. Is that?
Easy for you to say.
It's to ensure that each asset class is aligning with the objective for that asset class. But if we said in this case have 0% cash in private equity, it would mean every day we're taking money in or money out of private equity based upon the bills that are due that day. We think that's an operational inefficiency to do that every day. The time in doing that is a cost, and it would need an additional resource and an additional operational risk, because maybe the money gets there in time, maybe it doesn't, right? And so this is a balance between what we believe lowers the operational risk, improves the efficiencies, but ensures, in this case, that if it's in the private equity asset class, we're investing in private equity, but we're allowing a marginal amount to be in cash to make sure that any invoice, any commitments that we need to send wires out on, there's cash readily available to do that.
Moving on, now I want to mention on the next slide, you see the four main broad categories of the investments that we undertake in this portfolio. And Michael has mentioned this in the past too. We're not trying to fill buckets by any means, but these are all building blocks for this portfolio. You see them highlighted here in blue. There's a few other terms highlighted in blue, and that refers again to things that are in your glossary in the back for definitions or some further explanations. Joe touched on objectives of private equity portfolio. Of course, we're trying to earn a higher return in public markets. We're trying to diversify return streams and risk profiles with this portfolio. That's really, cash does not do that, hence the limitations there for liquidity purposes. Historically, private equity has achieved higher returns than public markets, and that's what we're trying to accomplish with this portfolio going forward. You see those listed on that page. Of course, there are risks involved with private equity, and we are constantly trying to monitor, manage around those. To name a few, you see them on the next slide. There's concentration in sectors, geographically, by vintage yield, which is the yield we invest in a particular fund. There are operational risks with these managers. Again, we're doing long-term commitments, 10 plus years with firms. We need to know that these firms are going to be in existence 10 years from now. And we're managing these, monitoring these constantly. And as I go through, we'll highlight or touch on slides, and I'll link this back to this page here where we can see where and how we do that. With a quick portfolio overview, I'll do this relatively briefly. Performance, we have reported on this in the August quarter as of fiscal year end 6/30. The overall private markets, private equity portfolio has returned since inception 12.3% annual rate of return. Note that this is 30 plus years, double-digit return on an annualized basis. We're very proud of that. Hopefully we can continue to do so. I mentioned earlier, it's about 1.2 billion of the total cap pension pool, or 11% roughly. In terms of the composition by strategy, again, these are not buckets we're necessarily aiming to fill. We're not targeting buyout strategy to be 70%. This is the current portfolio. It is very buyout heavy. That is intentional. But we continuously trying to diversify and look for other opportunistic strategies to fill in that portfolio.
When you say that the buyout strategy is intentional but not necessarily targeted, what sort of informs your choice, or why would you choose to make that one so heavy?
Current environment is one of the aspects that we take into consideration here, and there are in the buyout space the best returns, best opportunities to be had at this point in time. That will shift over long terms. That's why we have other categories in there. But we feel with this portfolio composition currently that is right-sized and intentional. I don't know if Ethan, if you want to make another comment there, or?
Sure. Buyout, I would say, is a more consistent strategy for returns. With venture, you tend to have very binary results and much longer tails as far as return of capital. Buyout strategies tend to return capital much sooner. As it relates to these distressed debt-related strategies you see on there, distress tends to be very opportunistic and cyclical. That's more from a trading-oriented strategy. There are more distressed strategies that are focused on financial or operational distress that sort of persist through market cycles. And then debt-related, maybe a high-level takeaway is you'll see that grow in our portfolio because there is a more consistent return of capital, less risk. And so on a go-forward basis, I would expect to see venture sort of constrict a little bit, debt-related grow, buyout sort of remain probably fairly consistent for the reasons I've stated.
Thank you.
Yeah, sure.
Is it also a manager thing, Ethan? More.
Maybe could you rephrase the question?
Well, I just are we more familiar with the buyout managers and more comfortable with buyout managers, or have more of an expertise internally evaluating buyout managers than we are with mezzanine debt-related managers?
No.
Okay.
We are very familiar with the market universe across strategies. We apply the very same process, whether it's a debt-related manager, buyout manager, what have you. So very simply, no, it's not competitive. Yeah.
I would add that some of it is a reflection of the industry. Historically, maybe 30 years ago, 20 years ago, the heavy majority of it is buyout and venture. More of it has become privatized in the recent decade. So now you have private infrastructure, private credit, other types of private opportunities. And so that's why the other buckets are increasing in our portfolio. So some of it maps to the industry and the opportunities that are there. Some of it is a preference for buyout.
Moving on to the next couple of slides, actually, just showing you the diversification geographically by countries within the U.S. by states. Again, you mentioned this at the August board meeting as well. This is a home country bias U.S. heavy portfolio. If you think back to page 3 briefly, we have a 30 minute in our investment policy on non-U.S. investments. You can see we were currently at 22%, so well within that. And something that we constantly monitor. If you wonder, this little sleeve called Other, those are simply countries that did not make up more than 1% of itself, so I aggregated those and realized we have that in a 50 sleeve there. You see Norway, France, a couple that come to mind that are falling in there. Similar picture by state on the next slide. Very diversified in terms of overall states, and again, you have a little sleeve there. Other, Montana is actually one of them. If somebody was wondering, states that did not quite make up the list. Moving on to the sector diversification. See here we've added the MSCI US Small Cap Index benchmark and sectors to it. John, you heard me earlier say that we don't manage to that benchmark. And this picture really tells a couple of stories, but we're clearly not managing to that benchmark. So we're very, very different. Again, that is intentional. It's really just to give you an idea of what that benchmark looks like, but we are certainly very different. To look like that. On the next slide, again, this leads back a little bit to that discussion, diversification, how do you manage around vintage year risks, for example. We don't want to have majority of the portfolio and just allocate in 2008 and then nothing for a couple of years. It becomes very important that we have allocations throughout every single year. This is the current portfolio market value, and it shows you what we have invested in those respective vintage years. Also spread out a little bit by these three main broad categories, where the fund of funds, secondaries, and green. Another point you can make here, and I'll mention this later in the presentation too, how we diminish the allocation to fund of funds, and we made that point earlier. You can see how the green becomes less and less and less in this overall portfolio picture. Another point to note here is that the three bars, 2012, 13, 14, you see those are the highest ones. Really the bulk of the portfolio is in those 3-4 vintage years. And that is not unexpected as well. Those funds are right around their height, halfway through their maturity, through their life. So that's where we would expect them to have the highest net exposure, highest market values after about 5, 6, 7 years of their life.
Thomas, are fund of fund and secondaries funds that we bought from someone else? Or what is that?
Essentially, yes.
Yeah, okay.
And we'll touch on that point in a little bit too. The next two slides are top 10 manager exposure and strategy exposure. And then linking that back to page 3, where we have the restrictions to the ranges. No manager as a whole is supposed to be more than 15% of the portfolio. You can see here Axiom Asia at the top of page 14. It's about 6%, $70 million. And on the next page, page 15, we have a limit on 7.5% maximum exposure to a specific strategy. In this case, that would be the Northgate 5 fund, which is about 3.5%. A couple of notes, and I'm going to hand this over to my colleague Michael here on Adams Street, which you see right in the middle of page 14, and the GI Partners for relationship on the bottom, page 15.
Yeah, go ahead, Mike.
On page 14 of the equity managers, what was the number? What was it?
The maximum?
Yeah, the max. You have 7.5 on the equity investment.
15% per manager relationship. So again, remember we could have multiple funds with a single manager.
Yeah.
So that's why I have a limit of 15%.
The other 7.5.
Correct.
Quick update, we've been talking about this for a while. I think Ethan has hinted to it. We've been looking at the portfolio for any strategic sales. As of last Friday, we've sold 11 positions in our portfolio in the secondary market. 10 of those were the Adams Street Partners that you see on page 14. Page 15, GI Partners Fund 4 at the very bottom. I will add, Adams Street Partners has been one of our longest standing relationships. That's how the portfolio was built out in the early days through fund of funds. Good returns, good relationship. At this time, we felt like it was, tail end pieces. So with where the market environment is, healthy equity markets, high leverage, lots of dry powder from secondary funds, it would be an opportune time to sell these assets. We've been looking at it over the last year or two, I would say. Finally, happily telling the board that we did transact on that on Friday.
So without specifics, but in general, are you pleased? Did it work out the way you expected? Or, I'm trying to get a feel for why you did it Friday, and was the market environment great? Or, I'd like a little more detail on that.
Seemed like a good time.
You wanted to get it done before Carl had asked about it.
I think we've been talking about it for the last couple meetings. It's a great time to be selling. There's a lot of money in the market. I'll talk about that later in some of the market environment slides. Lots of dry powder, just money on the sidelines. Secondary funds are pricing very high. We've been looking at these assets as well as many other assets in the portfolio. So we felt like there was very strong pricing for all assets. And so that's why we decided to sell.
So what was the total value of what you sold?
At a very high level, I would say that the asset value is approximately 70 million.
And then, what will happen with that 70 million? Will that go into the, making up whatever we have to make up every month for pensions? Or, and a concern I have is that as we sell on the secondary market and the money goes away, it reduces our allocation to private equity. And I think private equity is very important. And how do we preserve the investment level that we have had?
So the first part, I believe that cash has already been allocated to other capital calls. So that's been moved out. I do think we have other opportunities that we're looking at that we believe will outperform versus holding these assets. I will say, this is a discussion point that we've had internally quite a bit. There is no portfolio need to sell these assets. So, we are really driven by the opportunity to sell and the pricing. It's not, we're over allocation. There's a pressing need to sell at a discount. So we're only selling from an opportunistic type of.
Oh, that's a great answer.
No, so we certainly looked at all the positions for GI. We ran it through our internal secondary model, looked at their top assets, looked at revenue growth, EBITDA, margins. Felt like we got good pricing. We did not re-up in GI Fund 5, so that's another portion of it, and our willingness to sell that. But we are looking at good names, great names, bad names in our portfolio. It's really the value that we can generate on these sales. And so look at it very optimistically. If there's no more questions on the secondary sale, we'll keep on going.
Slide 16. This looks a little bit similar to an earlier slide we talked about the market value allocation by vintage year. So this is a different lens to view it, but we're looking here at the actual commitments made by vintage year. So this is not our actual exposure at this point in time. This is simply Emily or somebody else on the team reports about the investment that would be in this chart, commitments made by year. Interesting to see here how these commitments have grown over time. Again, a function of trying to be at a certain level, certain range, certain target of the private equity portfolio. We have a secondary sale or other events that certainly needs to be accounted for in this type of analysis, and that's what's going to lead into our pacing discussion just a little bit. Yeah, interesting to see here too is in the fund-to-fund exposure. I don't want to belabor the point, but the greenish bars, you can see how it decreases over time to the point that we are making less and less fund-to-fund commitments, focusing more on direct access. The most recent ones you see in 2016, 18, those are actually Asian-focused funds. That's the marketplace where we don't have that great of direct access yet. So we're utilizing fund-to-funds investments to gain access to direct relationships, direct general partners in that space. Moving on to the next page. There's a lot of stuff going on, so please interrupt if I'm going too fast and a lot of bars. I'll walk you through it. So the light colored blue bars is really the market value of the exposure that we have in private assets. See how it grows over time. Specifically over the last 5 years, 2014-15, it's steadily going up. In contrast to that, you see the thick blue line, which is our exposure as a percent of the total cap, the total pension. You see how that in the past 5 years is actually a little bit declining and somewhat stable, but certainly not going up. So this is a very, very important concept here for the pacing discussion. And the reason why we like having this range instead of a target is it's near impossible to actually hit a target and be there with everything going on in the equity markets, fixed income markets, public markets, secondary sales. That fluctuates all the time. Even though we're consistently growing the allocation, we might not be at a target. So then simply in the orange and green, you have the upper and lower range that are stated in our investment policy, 15% for the upper and 9% for the lower. You have to note that we are within that range. Certainly try our best to do so.
The market value would include only cash in, right?
That is our actual exposure when the manager has called capital.
When the manager's called capital.
Correct, exactly. That's how this is different from the previous slide.
Right.
Commit $100 million to manager A, there might be no exposure for some time.
Right.
We're actually going to go touch on that in the next slide. But yeah, correct.
Mr. Chairman,
Sure.
if you wanted to have lunch at noon, this may be a good break point because the next section, I think, will probably take us more than 5 minutes.
Because my head is spinning right now. He's
So
interested.
we have scheduled?
Yes.
5 to 1.
Come on.
Very quick and very small.
Okay, let's get started again. Floor is yours. And yours.
Everybody have their lunch break? Are we ready for the nap yet? Yes. Oh,
We'll get you there.
I hope it'll be really exciting, yeah. Before we dive into the pacing portion, and that was one of the highlight keynotes that for you to take away, just wanted to flip back briefly to slide 13 and 16, and have you compare those side by side, compare them out would be great. Just wanted to make ensure that everybody's following these concepts of market value versus commitments. So on page 13, you see how that curve, that graph kind of dives down at the end. So those are newer commitments that are in that phase where they're calling capital. I think we don't have as much of an exposure yet in terms of market value. So the 2016, 17, 18 is the smallest one. We're just recently committed to a number of funds. They are just ramping up the calling of capital and ultimately see that growth. Versus slide 16, you see the highest amount is actually 2018. That is the number of commitments in terms of dollars that we have made this year so far. That doesn't mean that these close to $360 million are actually invested at this point. Those are just commitments from our side. So that's a very important concept for the pacing discussion. Questions? So with that, I'll move on to the actual pacing section that starts on page 18. Have a pacing portfolio implementation. Michael and I will tag team that a little bit, but I'll start at the beginning. Pacing, intricate concept, sounds very complex. I always like to view it more as a roadmap or a guide, a plan. I want to go on a road trip and I want to go to Butte this weekend. I'll make a plan, when to leave, what to do, what to bring, what to bring. That kind of idea. More of a guideline that points us in the right direction where we want to go. At the same time, we need to consider a number of variables in terms of market environment. Great financial crisis might happen for a wrench into the whole plan, and then we have to make necessary adjustments within that pacing study. At the same time, we look at scenario analysis, where we look at different growth scenarios for the portfolio, for the economy, on scenarios, different types of variations that we need to consider. Same thing with the capital calls. Not every manager in each sector or strategy calls capital based on a certain schedule. They vary quite dramatically from one year to the other, from strategy to the other. So all of these things need to be considered when we look at these plans. And it's a forward-looking exercise that we try to give us guideposts on how do we get to that intermediate target or range where we want to be. Flipping over to the next slide, slide 20. You heard us talk about the J-curve. And you probably heard it or seen it, so we thought to give you a little bit of educational background and lead that single fund J-curve picture here on page 20 into the entire portfolio concept. So J-curve is really just the net cash exposure of a fund. On this slide here, you have 3 different colors. The orange bars are the contributions. So this is if we make a commitment to a fund. This is how they draw that from us. They call, send us a notice in the mail, say, hey, please send us a check for X dollars. That's what you see in those orange bars. The green bars are then the distributions that come from these investments that these managers do. So that's active cash flow coming back to the board in real dollar terms. The blue line is really just a combination of those, both on the cumulative net cash flow, if you want to call it that. You see how that dips down, it's negative because these folks call money from us, we have to pay them. At the end of the life of the cycle of the fund, we'll hopefully get that money back, and hopefully more than we paid for. So you see that here on year 8 and a little bit, that blue line crosses the x-axis. That's that point in time where the manager paid us back our original commitment. In this case, this is a hypothetical example, but in this case it was $30 million. So at this point in time, we paid them roughly $30 million. They paid us roughly $30 million back, halfway through the life of the fund. And now the real positive cash flow starts kicking in where we get more money back than we paid for. That's the idea behind it. In this case, you'll see at the end of the life, that blue line tops out at roughly $30 million. So this would be a 2 times multiple investment. When you gave them $30 million, you get about $60 million back. The way this was structured, it's also a 15% IRR in terms of return, just to give you an idea how these things work. And again, each fund, each sector, each industry, slightly different, but traditionally private equity funds have followed this J-curve. Looks like a J. That transitions to the next slide, slide 21. Unless there are any questions, so I will rush. Slide 21 is really just a transition. We're not only investing in one fund, as you heard us speak multiple times, we're doing multiple commitments per year, usually 8 to 10. Multiple funds will have multiple J-curves. They line up like this. I'll skip over to page 22 relatively quickly. This is then the translation into the overall portfolio where we have multiple commitments, maybe 8 to 10 per year, and we need to do that every year. We can't just pick a year and say, hey, we want to commit $1 billion because we want to have $1 billion private equity portfolio. We need to serially commit over time to actually get there. So this very colorful chart, you see different bands. These are commitments by year. Each year, again, up to 10, potentially 7, 8, 9, 10 funds. Committed $400 million in each year, and you see that we don't reach that $1.2 billion portfolio size exposure until year 8 or 9. So it's really a long-term focus for us, for the team. Keep that in mind. We need to serially commit to build out to these targets and portfolios. And at the same time, the cap public markets, things change, portfolios grow. That's where the pacing statement comes in, where we need to potentially make adjustments here and not just blindly keep committing $400 million a year. Something may have happened, something might have changed. Public markets keep going up. Joe always says it's a great problem to have. You got more money in there, but that means that we ultimately will have to commit more dollars to keep up with that pace. That I'll hand it over to my colleague Michael.
So on page 23, this is a very simple graph with a lot that goes behind it. We have RBK, we're on the pacing study for 3 asset classes that we focus on, PE, real estate, and natural resources. We have to run it at least once a year. It's quite lengthy. This is really the distillation of that. We run it on different scenarios, negative growth rate scenario, flat growth, expected growth. This is with RBK capital market assumptions. High growth, look at different J curves, so different asset classes, different geographies. So each strategy, geography might have a different J curve that's built into this. But at the headline level, the blue line here is our actual historical allocation. You can see for the last 5 years, it's been around 10%. The yellow line is the midpoint of our range. Our range is 9 to 15, just for this chart. We're just showing it as 12%. The orange is really just shown for illustration. If we didn't make any commitments to private equity, what the portfolio would do. And you can see it would tail off pretty quickly. The next couple of years, managers return, funds would close down, we made no commitments. Our exposure would go down very quickly. It's a long-term view, we need to commit year in, year out. That's really what the green line is. It's our expected plan. This is one pacing plan that we have. We run different scenarios. We have one where it steps up quicker, one that ramps up really quick. This is kind of the medium conservative plan. We could ramp up, commit $600 million this year, but then if something happened, we'd be over allocated to just NDP. So we're very cautious and very wary about over allocating or under allocating our vintage years.
And is that throughout the year sort of soft target, or do you at some point set a target and say this is the number for the year?
So it's a soft target. We have a number in the next couple of pages. It's a soft target for us. We tell all of our investment managers people walk in the door, we're not dogmatic about it. We're not filling buckets. That's not how we do it. We're very focused on managers, the opportunity set, and we'll fill it bottoms up. But it does provide a framework, a guideline for us to look at in this long-term context.
Thank you.
Page 24. This is our historical pacing. You'll see 2018 year-to-date, 365 million committed. Looks very outsized compared to historic. But I would say, this is on plan. Historically, maybe we have underallocated or been more conservative in our commitments. I think we've talked to the board in the past year about our commitment sizing. That is probably more right-sized based on this pacing plan. Page 25. Carl, to your point, this is the headline number that we're looking at per year, 350. There is certainly buffer to go up. I think between us, we would go up to 450 or even more. The opportunity set.
Just
between us. And again, it's not something that we really tell external managers because we don't think of it that way. People ask, "What's your 2018 allocation? Are you going to run out? Do you need to be a 2019 allocation?" We don't really think about it that way. We think of it long-term, multi-year, decade planning. So if we go over a little bit, that's okay. We're at 10% allocation. We have a long way to go before we even hit 12. The baseline, kind of a long-term strategic view, we're looking at 350 million per year, 7 to 9 plans, 25 to 75 commitment size for our managers. 25 might be niche strategies, something that's locked in for a longer time, has kind of a long J curve, something like VC, which is your capital is going to be out for a very long time. And then you'll have these big companies, more of a binary result. Whereas something like credit has a very shallow J curve. You're putting money to work, but you're getting current coupon or interest payment back. It's a very shallow J curve, so you can
Question, I don't understand what you meant by binary design.
Yeah, so these, for venture, most of the times people think of venture, you'll get 3 buckets of returns in a portfolio. One is a third of the bucket, you'll get your money back. A third of the money, you'll lose completely because these are startups out of garages, incubation. And then the third are the big winners that will drive the portfolio. So the binary part is really the big winners offset by the complete losses. Moving on to page 26. This is a further breakdown of the commitments we've made in 2018. Totals up to 365. We haven't made any distressed commitments. We're certainly looking at the asset class for a couple of the reasons that Ethan mentioned earlier. There'll always be a smaller part of the portfolio. a little cautious on those kind of investment strategies where you need macro dislocation or optimistic for it to work. Whereas, buyout is more of an all-weather type of investment. Page 27. This is a look forward of the patient study. You see on average it's $350 per year.
The further out you go, the less, is it that the further out you go, the less comfortable you are with the number?
Yeah, I think so. I mean, that long-term number doesn't really matter as much. We're rerunning this plan every single year.
Right.
And, want to be closer to target every single year. But it's really hard to predict a 10-year number and what's going to happen. But, so less meaningful to look that far out. So that's pacing and how we think about it. I think there's a lot that goes into it. Hundreds, if not thousands of different underlying assumptions. It's part science in building those models. I came from consulting. I run that model thousands of times, sitting up there late at night. You can fine tune it to death, but at the end of the day, they're all assumptions. What really matters is commitments, and investments that you're making and what they build up into. And I think that's kind of how our group looks at it.
How often did you say we do a pacing study?
At least once a year.
And RV Coombs does that for us?
Yeah. And they do a great job with it. They give us decks, we run scenario analysis, different scenarios, we have different numbers, we run a lot of different scenarios. This is really kind of a baseline average and how we think about it. We'll move on. Page 28, market environment, strategy rationale. I think Ethan mentioned a lot of these stats at the board meetings. We kind of referenced them, but want to show the board kind of the historical charts, so you have a good baseline reference for what they mean when we reference these data points. Page 29, purchase price multiples is what we often refer to when we're talking about valuations. Purchase price multiples is enterprise value over EBITDA. So value of the company over essentially net earnings, plus interest, amortization, all that. So that's how we think of valuations within buyout. So on this chart, you can see the last 5 years, we're at a 9 times, a 10 times high historically. Look back to 2007, pre-GFC, it was at 9.7. The last 5 years have been at valuation levels, on average, above pre-GFC levels. So when we say valuations are high, that has been persistent. Maybe that will be a new norm. Maybe this will persist into the future. That's TBD, but valuations are high compared to historical norms. Page 30, debt multiples. This is the company's total debt over EBITDA. You see in this case, last 5 years, 5.7, 5.6. Debt is cheap. It's available. Buyout managers are utilizing debts. We look at this whenever we look at buyout manager. How conservative are they or aggressive are they in using leverage? We prefer managers that don't rely on leverage to generate returns or engineer financial returns. We want managers that are creating value either to top line sales or EBITDA or expanding margins. And when we think about buyout managers, we look at a value bridge. Are they getting returns from creating operating value? Is it leverage, or is it just multiples that the markets are giving them? Page 31. This is the fundraising chart. The bar chart is total dollars being raised. Line chart is number of funds in market. You can see this is historical high, 3,000 funds currently in market fundraising within private equity. You say you look at the majority of them, more than half. Either have a conversation or look at the marketing deck. We go through a lot of these to come up with best ideas. But there is a lot of money out in the market, a lot of managers, and so that's what's driving a lot of the valuations up, is there's so much capital in the market. Page 32. For the board members that were here last year, this is pretty much identical to last year. This is how we think about the portfolio within private equity. Focus on North America. Selectively, we're going to add international exposure. Historically, it's been built out through Axiom Asia as private fund. We've been doing more and more direct deals. This year we did OCP on the credit side. Also Crescent Point, which is buyout and growth in Pan-Asia. So I think that we spend more time in Asia and developing relationships there. There will be more focus on the direct portfolio as opposed to having our exposure through Axiom open funds. Third point, moving program towards smaller cap strategies. That's something that's been ongoing over the last 5 years to 10 years since really Ethan's joining. There's been a big shift. We feel like that is where value can be created in the private markets. A lot of the large cap kind of blends with small cap public equities. So we really do feel alpha, the opportunity for alpha is generated in the lower end of the market. We're very selective with larger market cap or buyout managers. We have been pulling the portfolio. There have been a lot of managers that we have existing in the portfolio that we have not re-upped with. I think we mostly only talk about managers that we do commit to. But there's certainly been a lot of hard decisions over the last year or two to managers we certainly respect and have performed well for us that we have not re-upped with. Page 33, increased emphasis on non-correlated strategies. Talked about it in the past, we have a life insurance focused strategy. We're starting to spend more time looking at infrastructure as well. Opportunistically, we'll add venture exposure. That's always going to be a smaller part of the program, just because we can't scale as much in venture as we can in buyout. But we look at opportunistically. I'm in San Francisco later this week. We'll be looking at 3 venture managers. So it is accretive to the portfolio. It'll just never be a large portion of our portfolio.
And we can't scale it wide.
For the managers that we like, we like the early stage portion of venture. They raise smaller funds. If they're raising a $200 million fund or $300 million fund, we can't write a $50 million check in those fund sizes, nor can they take it because they want some diversification. They're usually oversubscribed because they've had a history of success. So we're not going to spend valuable bandwidth to build a portfolio of 10 venture names in 2019 so that we have some scale there. So it'll always be opportunistic for us. Direct lending, we've made quite a bit of headway there. Over the last year, we made a commitment to OCP, direct lending manager in Asia, Deerpath, out of New York, which is lower middle market direct lending. We made a commitment to Capital Spring, which is direct lending to restaurant franchisees. So as Ethan mentioned, this will be an increasing portion of the portfolio moving forward. De-emphasizing fund of funds. We've spoken about that ad nauseum. Selling off non-core fund of fund pieces in our portfolio as well. Last point, opportunistically sell in the secondaries market. We're always looking at that. We'll hand it back to Vince.
Well, before we move from there, what aren't we doing?
What aren't we doing?
Yeah, that other people are doing.
Yeah.
What aren't we doing?
We're really shying away from the multi-billion-dollar funds, the large caps. We're very selective there. We have pretty good relationships there already in our portfolio. So it's a very high bar. We're not doing mezzanine financing. which is subordinate to direct lending, senior secured managers. We just feel like it's late in the cycle, so we really shied away. Not that we won't do it. We're certainly looking at managers that are more conservative, but just where they sit on the capital stack in today's environment.
Because because there's money available and interest is cheap, is that?
Yeah, it's very competitive. It's banks, there's a lot of providers. So spreads are pretty tight in the mezzanine portion. We felt like it's pretty frothy there. So that might be one way to build out our credit portfolio, but I think we're taking a more conservative stance and maybe adding more to direct lending, focusing there. We're not doing a lot of distress. We'll go through the portfolio later in performance, but we don't want to rely on market event for these managers to execute. Maybe we'll look at more distress trading, where stuff always happens and there's always points of opportunities, but as far as a manager focused on large macro opportunities, that might be less appealing to us. We're not doing much late stage venture. Looked at a couple funds, haven't done any, valuations are very frothy on the back end of venture. There's a lot of public money, T. Rowe Price, a lot of big funds, hedge funds that are kind of pushing up the valuations. I don't know how many billion-dollar VC companies there are today compared to a decade ago. There's lots, and it's because valuations are driven up because financing is readily available at VC.
We're not blindly following the herd.
They're not blindly following the herd. Shucks, I wanted that.
Montana's well known for building their own opinions and having anything in the marketplace. Just because the public pension is doing something that doesn't mean we have following.
We could go on infrastructure, though we're looking at it, for example. But Michael covered the landscape pretty well.
Okay.
I don't have.
And we're not doing infrastructure?
Correct.
We're not currently, but I'd say we're actively doing a lot of market mapping, understanding the different risk spectrums of infrastructure. I think it's an interesting asset class for someone such as a pension. The asset liability mix makes sense. There's good yield in that, good diversification. We're just not there yet. We're starting looking at it.
Moving on, taking a quick look at the investment process. We heard a lot of comments on this already. We thought it might be worth spending a little bit of time just walking through it. And as Michael already alluded to, there's a lot of things that go into it, and not just a simple circular chart here on page 34. Each one of those fields is really a multitude of different aspects, different teams, calls, what have you. But following the circle here a little bit, we start with the deal sourcing, as Michael mentioned. Over 3,000 funds currently raising capital, resourcing deals or opportunities from various databases, from relationships we have with general partners. We're going out and participating in annual meetings with the relationships we have, and make connections, their relationships with other limited partners like ourselves. That's really a web of relationships, if you will, and databases where we get these ideas. And then, of course, general partners send us materials, call us, or visit us directly. Once we go through that step and have a good opportunity, we think we have a good opportunity, we start our internal due diligence process, and I don't want to go into each individual detail, but it is a very rigorous, thought-out process that we follow as a team. We have a consensus approach in place, so any of the five of us can at any time, on comfort level, something's not clear, I don't want to move forward with this particular opportunity, that is on the team to convince that person otherwise, or that deal simply dies. That process includes internal write-ups anywhere from 15 to 50 pages that will hopefully successfully distill down to a one-page board brief for your digestion, so you don't have to read 50 pages. Your CIO, Joe Cullen, gladly does that for you. He's always involved when we come to that stage where we have the internal reports. Joe gets involved and offers his perspective as well. 2.0 vision. Again, the investment decision I mentioned is a team approach, consensus-driven. We all need to be on board. It's a high-conviction manager who move it forward to the decision. That's then the ultimate board briefs that you get to see the decision made. There will be a legal review process. We have an external legal counsel that helps us with reviewing contracts, factory coverage, and so forth. Do that in-house. And then, of course, the last very important step of the entire investment process is the ongoing fund monitoring. Do that on a daily, weekly, quarterly basis that people, everybody has assigned relationships on the team, participate in quarterly calls with the general managers, again, visiting annual meetings, constantly following up what these guys are up to. If there are any changes that hopefully let us know, we'll probe what that course. This process, oh, sorry.
Do I remember this right? A couple of years ago, we hired a new law firm or did a...
So the history looks something like the following. In 2011, and prior to that, we used a local firm, Lux and Murphy. I think we still employ them in some respects, however not in the private investment program. It was approximately 2 years thereafter that we switched to Jackson Walker upon a recommendation that I had made, given my experience through the ILPA Institute and building some personal relationships that I suggested and just given the complexity of the investments we're making, I really pushed the idea of us having a more sophisticated law firm cover us, and they had the added benefit of basically having no fund formation practice. It was strictly LP focused, so there was arguably no conflict of interest where they were working with GPs on one end and then representing LPs on the other end. As recently as August, I believe, of this year, that team that we had aligned ourselves with, Jackson Walker, spun out and moved to DLA Piper. We followed that relationship. We now have a contract in place with them while additionally maintaining a contract with the existing group at Jackson Walker. The idea being that we want coverage to the extent that capacity is constrained. Either way, we can pivot accordingly and meet our needs.
And it's working?
Absolutely. From my perspective, for sure. No doubt about it.
And how does that work? I mean, is there a point where you say, okay, we're ready to do the deal, here's the documents, will you look at them, or are they involved early on?
So it comes in several different permutations, but generally speaking, it's towards the tail end of the process. There's a certain level of expertise that has been developed amongst the team, whereby folks have a certain level of comfort. There is one specific term or part of piece of language we look for, and we've built that into the phase one of our process, which entails us scouring the document, looking for essentially the term sole discretion, and specifically as it relates to them being able to put the interests of themselves, a general partner, before the partnership itself, the limited partners. And to the extent that exists, that's an absolute bright line for us, and we would not proceed without some very high level of conviction after a very professional discussion with the general partner that they are willing to change that language, because that's, they're essentially waiving their fiduciary duty and putting us in the passenger seat, which is a non-starter.
But, that's something that you look at the beginning?
Yeah, absolutely, for sure,
And there might be others.
There are certainly others, but for the most part, that is a very bright line, so we work hard to get that addressed early on. But I'd say 99% of the time, Carl, is we're bringing them on board after we've had consensus. Joe's essentially signed off. Dan will sign off because they both need to sign off before we proceed and, with the final decision.
Okay, and then you send the documents to one of those firms?
Correct.
And what's their turnaround time, generally?
Turnaround time can be anywhere from a day to a week. Okay. Yeah, it's pretty quick. Pretty quick. They'll send us, they've got a legal summary checklist that they'll go through, which essentially goes through every provision within the limited partnership agreement. They'll provide sort of a summary of that, their comments as to where we should push, what they think is market, outside of market. We'll formulate a strategy around that, go back to the general partner with an issues list of each one of those items. In many cases, we will address that list directly with the general partner before even engaging legal counsel in an effort to, minimize costs and really just have that conversation, say, hey, we don't think this is reasonable. I think between the two parties here, we can come to some accord rather than just having us go back and forth and, rack up billable hours.
Not that there's anything wrong.
Having made no progress at the end of the day. And then an issues list will go out, it'll get annotated, there'll be a couple of iterations to the extent there are major sticking points. We engage, I've encouraged the entire team to not rely on counsel all the time, but really have these direct conversations, and I think that's super beneficial, not only for building the relationship, but, they understand we're serious. Many times you'll find, or I have found, that the general partners are not even aware of certain terms within their partnership agreements, and they say, gosh, you're absolutely right, that seems completely unreasonable, let me talk to my counsel about that. So I think it has a lot of benefits by having that direct connection.
And related, I know you've got a rule about no political contributions.
Correct.
Right, is that in the agreement, or is that part of the, or does that come over here in due diligence, or does that come up in legal review, or what is that?
Sort of all the above. It's definitely part of the phase one. One of those very bright lines that we get out on the table very early on to assess whether this is going to be a workable relationship or not, just to be respectful of our resources and their resources. And we will ask them, and we demand that they agree to it in what we refer to as a side letter, which is supplemental to the limited partnership agreement. And they'll agree. We agree not to make political contributions to any, state, municipal, or federal representatives of the state of Montana.
Thank you.
Yeah, sure.
So I'm on page 36, just jotting that investment process moment. This was pointed out in the past as well. It's ever-changing, continuously evolving process, but as it's currently in place, we've gone back a little bit and have some data for the past year and a half. Michael pointed out, on 3,000 funds in the market, we have for sure looked at over 1,000 of those in the last 18 months.
To clarify, that 3,000 is all private capital, so it includes real estate, natural resources. This triangle is only private equity. So I do think we probably look at probably a majority of half of those 3,000 funds.
This triangle shape is also in our colleagues' real estate presentation. I like so much stuff. Wanted to include it here as well, just to see how it funnels down from these ultimately over 1,000 deals that we look at. Narrow it down to 11 commitments overall, so it's roughly 1% of that, just to show you all the work that goes in there. The steps in between, we haven't everything lined up here yet, but it's certainly a lot of work that goes into it. We're on the phone meeting with probably 250, 350 general partners every year. We have a deeper relationship with, we're looking at them, that ultimately filters down to about 20 to 30 that go through the entire due diligence process internally here. And those are then the 20 or 30 opportunities of deals where Joe then gets involved and is in the room with the team looking at these more closely. That ultimately gets filtered down to about 11 commitments that we made over the past 18 months. Just to give you an idea of the sheer size of the work that's been done by this team. questions. Now, flip to the last section. Bear with me for a couple more slides here, slide 38 to 42 in total. So that's the actual line item by line item listing of every single relationship that is in that private equity portfolio. In consideration of being after lunch, I'm not going to walk you through each single one. We have them filtered or ordered, if you will, segmented by the large 4 sleeves buckets that we are talking about. The first 3-4 pages are buyout strategies. Within those, we've broken them out by large mega, the middle market, and the lower middle market buyout strategies. And within each bucket, there's sorted by vintage year. A couple of notes, a couple of points I wanted to highlight here. If you flip to page 40, you'll see less and less italicized names in that list. Not to belabor that point, but those are the fund-to-fund investments that we're actively trying to reduce. So the further you go down on this page, the less italicized names you'll see. And the other point I wanted to make, if you look at the commitment column, original commitments, right half of that page, you see how it changes from around 20 million on average at the top of the page. You go down all the way to the bottom, more like 40 to 50 million. That's the point Michael was making earlier in terms of check sizes, commitment sizes over time. As we build this portfolio out, these will grow and become larger over time. The next page is our debt-related strategies. A couple comments were made there. We are looking at the space. There haven't been many commitments recently. Simply continuously evaluating, and at this point in time, there's just other opportunities that we pursued. On the last page, page 42, is our venture capital exposure. I made the point earlier, it's essentially the entire portfolio is an early stage venture capital. It's just one legacy fund, the Adams Street Brinson Fund, that was in a late stage venture capital. Happy to answer questions. I don't know if I have an answer for every single line item if you ask me, but I'm certainly going to try. It's really for your reference to this.
Who are the problem children?
Problem children, so there's no real problem children at this point. A couple of things maybe we can highlight on page 38. We don't get it right all the time. There's always going to be something that doesn't quite perform to expectations. So the top of page 38, you'll see 2 names in there, Terra Firma and JC Flowers. 2 of our large, older buyout funds. So you recall the J-curve picture we talked about at length. So these funds are 2006, 2007 vintage funds. They are clearly supposed to be at the end of that J-curve after 12 years and be in positive return territory, positive cash flows. Unfortunately, they did not perform to expectations. We have negative returns here. That happens. That is another reason why we built a diversified portfolio. We're not putting all eggs in one basket. We have a $1 billion investment with Terraform, for example, to pick them. But not a huge concern. Again, they're not up to expectations, but you can't get it right all the time.
Thomas, to understand some of these numbers properly, go over on to page 40.
Okay.
Seems like the more recent commitments, obviously there would be a big difference between market value and commitment because the money's not been drawn. Is that fair to say?
That's correct, yes. So the most recent ones, there's no market value, at least that have called it.
And so if you go back to, say, the Angeles Equity Partners in 2015, it seems like it's long enough they probably would have called their money. Is it fair to say when the investment multiple is below 1, that means that there haven't been significant distributions? Or how would you interpret that? I mean, I don't care about the details of Angeles, I'm just trying to understand the term.
Hi there, and I'm going to pass this over to Michael. Actually, he was here underwriting this opportunity. This was slightly before my time, so on that question off. But eagle-eyed to find Andrew.
A little bit before my time as well, but I can answer the question. Sometimes they're below, it's because of fees that they're calling down. And so if they haven't marked up any of the companies or they're holding it, they'll be below. Other times it's because they're calling fees and the companies aren't performing, I get let down. So Angeles is certainly on the watch list. You know, they've been slow to deploy capital. Going to their annual meeting next week. That'll be quite a
You know, there are a way when if we look at that, we can say, okay, this is more a function of not for performance, but slow to draw the capital. So you can hear that.
From here, it'd be very hard to tell. Even for us, it can be hard to tell. So we have conversations with managers. Why are they slow to deploy? You know, I think we're essentially paying them to deploy our capital. We're investing. We want them to deploy. On the flip side of that is it's a very high valuation market. We don't want them to deploy just so they can earn fees. We want them to deploy our money cautiously and as good fiduciary investors. So we do want them to be methodical and disciplined with what they're doing. So it's a balance between that.
But I think to your point, there would still be a little bit of calculus involved, but we could certainly add 2 additional columns. One that indicates how much capital is drawn, and another that indicates fees that have been drawn. And to the extent you saw a commitment of 20 million and you saw $20 million of capital drawn, you know, across fees and the capital, and you saw a market value of 1.2 million, you could certainly ascertain from that equation that, wow, they must not be performing, versus, you know, the opposite, where maybe it's a $20 million commitment, $1.5 million has been called, 250 in fees, and the market value is 1.4, kind of say, oh. So if that would be helpful, we could certainly go down that path on a go-forward basis. I think it'd be helpful. So, duly noted, we'll pivot accordingly.
ITD, I know what IRR is.
Inception to date. ITD. Good call. We should probably add that to the glossary abbreviations.
Those are the numbers you hear me talk about at the pension meetings when we have a bad year.
We don't use ITD, yeah. Just write out inception to date.
You go to page 41, you look at the stress for control. The investment multiples, they're fairly low for what they are. We think, you know, those funds that are a decade old would perform a little bit better. You can see that non-control similar vintages are outperforming for control managers. You would think there would be more value creation in control. Are you getting paid for the risk you're taking in control distress situations? I don't know. And you know, just looking at these, maybe not. So I think we're very cautious about, you know, we're going to put any money in control distress situations, those strategies. Page 42, you can see that performance is pretty good on the top half. A lot of that's fund of funds. You know, using fund of funds to gain access to top tier VC names, that makes sense. We're not going to build out the portfolio ourselves. We do opportunistically, but you know, these are great fund funds. You know, I think they're often in the market. We've looked at them. People will trade on them at a discount. You know, we feel like there's good value underlying these fund of funds, good companies. So we've been reluctant to sell those positions. That's all I got.
That's all the comments we have prepared.
If I remember it right, and maybe I don't, but we've got some sort of soft statutory language about taking a look at companies that invest in Montana. You know what I'm talking, Mike?
I'm familiar with that.
Okay. Are we doing that?
We are not deliberately going out and trying to invest the private equity pool in Montana-based companies, to answer your question very directly.
Okay.
I would say that we are when they reach out to us, right? So, when people have reached out to us, we have included them in our process. And recently we have not made investments in that area because it hasn't gone all the way through this full due diligence funnel and reach the point that we have selected those funds in the last few years. But we have and will continue to consider those opportunities in line with how it's softly written in the statute.
Okay.
Isn't this one fund Highway 12 Ventures, wasn't it?
That was our, right, that was an attempt.
Right.
And it didn't work, did it?
Right.
There were a couple. Montlake Capital 3, which actually agreed in their side letter to look at Montana. They're based in Seattle. And they annually would provide us a list of companies that they were looking at in Montana. And for reasons very similar to what Joe mentioned, they would diligence those companies to look at them and they would fall out for various reasons. Highway 12 was invested in a company called Goomsey in Missoula. And I believe that is it. The investment has worked out. I think they're at over a 2x net multiple, but that's just recently, so maybe to Michael's binary reference earlier, they have had one very recent big win, a company called SendGrid that is now publicly traded. We recently received, I don't know how many shares, 350,000, 290,000 shares. The company's been trading between 35 and 38 bucks a share. Randy's been winnowing through the shares, and the ultimate return multiple is yet to be determined, but it was a big winner. For all the losers that they've had, they had one really big winner that is really essentially returning the fund and then some on our behalf. So that's sort of a typical early stage venture capital return profile, fund return profile. So, but up until recently, it was I think about a 1.2, 1.3 times, which arguably is still accretive, and it's a winning investment, but it hasn't been a screamer, if you will.
Thank you.
Thank you very much. Thank you.
Yeah. We're on to number 7. Case management of state management.
I'm going to start off with some bad news, good news, bad news. Bad news is Julie's not feeling well. Good news is she left me a script. Bad news is it's 5 pages long. So I'm going to try my best.
Frank, could we give it a couple minutes? We've got Kim that's calling in from US Bank.
Oh, sure. You want to take a 5-minute break?
If you don't mind, because it might take that long to get the conference call set
That's
up.
fine with me. I need to take a 5-minute break.
Would the guests that just came in, would you sign in the sign-up sheet by the end of the table there, please?
Frank, way down super early.
Way to go, Frank. Good job. Now you can leave.
Okay, we're on.
Right now, I don't get to use the computer. Big problem.
Okay, Kim, we're back in session. Hello, everyone.
Hello. Welcome.
Thank you.
We're on? Yeah. All right. Kim, can you hear us?
Yes, I certainly can. Not very well, but I can hear you.
Okay. I'll try to speak loudly. I'll give you
I kind of chunk this out into sections, and I'm gonna allow time for questions in between, because it's 5 pages, like I said. If you have any questions.
You can summarize it.
Sometimes, yeah. Sometimes I might pass on some questions to the experts down at this end of the table, but I'll go ahead and get started. Should we wait for, are we good? Just go. All right. Our objective is
She excused herself, she's on her way to Italy.
Oh, all right.
Bet you wish you were joining.
Yes.
And also John had a meeting conflict, so we're good to go.
All right. Thank you, sir. Our objectives this afternoon are to provide you with a general overview of some of the coordination needed and some of the controls surrounding cash management for the state, and talk about some specific areas that the Board of Investments are responsible for and some areas the Department of Administration is responsible for. The key to a successful overall cash management for the state of Montana are communication and internal controls. There are 4 major players regarding the state's overall cash management. We all have a very unique role, and yet our roles are intertwined and dependent on one another. The major roles for the major players are the Board of Investments, Department of Administration, U.S. Bank, our depository bank, Kim is on the line, State Street Bank, which isn't on the line today, which is our custodial bank. And so that's the introduction. And I'm going to go into the daily movement of cash between the board and the State Street Bank. Investment staff utilizes the state cash flow information from the Department of Administration by 3:30 each afternoon for trading the next morning. Investment staff will also pull reports from U.S. Bank the next morning as well. Here at the Board of Investments, we are responsible for authorizing and processing the daily cash movement sheet. This is the instructions for daily wiring money between State Street and U.S. Bank. The cash movement sheet is prepared by State Street based on instructions from the board by 10 o'clock every morning. Investment staff confirms the information from State Street. Upon confirmation, the investment staff, the board accounting staff will then complete the associated daily processing, such as recording trades, buys, sells, income distributions. Items on the cash movement sheet are supported by documentation, including authorization and review. Over the past year, a significant change has been made in how the cash movement sheet is processed by the board. In the past, this was a very manual process, with paper physically moving between the investment and accounting staff, then moving to State Street via fax. Now the investment staff are utilizing the State Street system directly. We call it ECFM. This change allows for processing of cash movement sheet by the investment staff at home, which increases the board's flexibility during a disaster. It reduces several manual steps, and our controls have improved with an additional electronic audit trail and electronic approval documented. Accounting staff daily reconciles the information from State Street. These reconciliations are reviewed by either an associate financial manager or a financial manager. We also run daily cash reconciliations the next day as an additional step of verification. Do we have any questions concerning the daily movement of cash? Seeing none, I'll use my Ethan Hurley rush. Sorry, knock. The next section is the board's relationship with the bank. The daily operations section with the Department of Administration State Financial Services Division processes wires in or out U.S. bank account on behalf of state agencies, including the university system and retirement system. They also reconcile the U.S. bank account. Department of Administration staff daily communicates with the U.S. Bank and Board of Investment staff regarding cash. The state accounting system, SABRS, is maintained by the Department of Administration on behalf of state agencies. The system processes daily payments and deposit files with U.S. Bank. The payments include payments to vendors, payroll payments, retirement payments, and payments to local governments and school districts. The deposits by agencies include the submission of U.S. bank and tax revenues, changes for services, receipt of federal funds, receipt of other grant money, and revenue. The Department of Administration prepares monthly collateralization reports and estimated general fund projection report as well, both of which are provided to the Board of Investments, as well as staff from the Governor's Office and Legislative Fiscal Division. That goes a lot into DNA, so Kendra will be covering more of that. Our relationship with the depository bank, by contract, the U.S. Bank is the main state depository account. They are used for transactions involving payments at the depository for most of the monies flowing into the Montana Treasury. In limited circumstances, agencies may make deposits in local bank accounts, and then the money is swept into the U.S. Bank depository account. Going on to the custodial bank. By contrast, the State Street Bank is our custodial bank. State Street is used by the board to track, manage, and administer the Unified Investment Program. State Street is often referred to as our book of record here at the Board of Investments. Per our instructions, State Street handles the movement of money to and from U.S. Bank and handles the movement of money to and from third parties regarding the purchase of sale of investments and earnings and distributions on investments. Seeing if there's any question on the custodial bank relationship, I'll go into treasurer's cash. The major component of cash within the board involves management of the STIP and treasurer's cash programs. The treasurer's cash program is also a large STIP participant. Both programs are highly liquid and many transactions dealing with both actual purchase or sale of individual securities and purchases of sales of participant shares in and out of the pool. They also both help applicable state agencies and local governments meet their daily cash needs. And John will cover treasurer's cash. Now I'm going to go into STIP. Each STIP participant can initiate daily STIP purchases of sales via our web portal. The money from local government participants automatically wired between the local government bank accounts and State Street. Money from state participants incorporated in the daily cash movement sheet. Board of Investment staff initiate the daily purchase or sale of securities within the state portfolio. Accounting staff communicates daily with State Street regarding both STIP participants and investment transactions. The board and State Street are currently undertaking a large project to convert from the existing web portal to a new web portal. It's moving from a third party to an in-house State Street portal. Currently, we have approximately 1,500 STIP users within the state agencies and local governments. We want to make sure that everything is in place so that state agencies and local governments do not see any impact on their ability to request STIP transactions and their ability to manage their cash within their operations. Intercap. The board also handles large amounts of cash regarding other investment transactions pertaining to the in-state loan program, mortgages, and intercap transactions. I'm on page 4. Alternative equity transactions.
We're doing fine.
All right. Yeah.
You got a long way to go before you can
I'm okay with any questions. Investment trades and alternative equity transactions are initiated and authorized by investment staff. The board also gets communication from third parties regarding earnings and distributions. Accounting staff communicates with State Street on a daily basis regarding these transactions. In turn, money in turn will flow in and out of our custodial account per board staff directions with proper authorization and review. In-state loan program, regarding the in-state loan program, board accounting staff fund approved loans to participant banks or borrowers and initiate the collection of loan payments upon receipt of proper payment and authorization. Accounting will initiate ACH or wire through the U.S. bank system. Board staff also prepares related accounting journals and communicates with State Street regarding the in-state loan program. Mortgage program. The Board of Housing acts as a primary loan servicer regarding mortgages due to the Board of Investments. The borrowers pay the Board of Housing, which then turns that in turn remits payments to the Board of Investments. The remittance do not involve a bank transaction by the Board of Investment staff because the Board of Housing records the deposits within the U.S. Bank at the time of receipt. A Savers inter-unit journal is utilized to move the money to the Board of Investments. We communicate daily with the Board of Housing and State Street regarding mortgage transactions. Our Intercap bank account, we use a separate U.S. account to maintain the Intercap activity. By indenture, U.S. Bank is acting on our behalf as the trustee. Money from bond issuance, bond payments, loan payments, and for new loans moving in or out of this account, money can flow from Intercap account to the state's main depository account when an agency is a borrower. Board staff is responsible for reconciling this separate account. Board staff also communicates with Department of Administration and U.S. Bank staff regarding this account as well. And then a little bit of our internal controls. Some of our general internal controls utilized by the Board of Investments include the separation of duties between the Board of Investments and accounting staff, board staff, and the Department of Administration staff, and board staff and U.S. Bank and State Street staff. There's separation for you. An example is reconciliation of U.S. information by the Department of Administration and the reconciliation of State Street information by board staff. The reconciliation should reflect the same daily movement of money between U.S. Bank and State Street. At the board, we also have controls in place as to who has what access in regard to the system we use. We also establish dollar limits on transactions that individuals can process. Access and limits are only granted upon proper authorization and approved by very select individuals. Usually board senior management has that ability to select who has access. Access limits and transactions are periodically reviewed. Accounting staff completes numerous reconciliations pertaining to the transactions that have been reported, including those involving cash transactions. Some reconciliations are completed daily, others are completed monthly, others are completed quarterly. The reconciliations are reviewed by either an associate, financial manager, or financial manager. Here at the board, we have an internal control policy that is frequently reviewed and updated. We had a SOC 1 Type 2 audit from a third party on the board's internal controls recently, and we also have our financial statements audited annually by the Legislative Audit Division. Again, the success of the state's overall cash management process relies on daily communication and coordination. Our responsibilities here at the board are dependent and intertwined with the Department of Administration, U.S. Bank, State Street, and other agencies and other third parties. And that's my conclusion. Jack asked me to add a joke, and I wasn't able to get it into my presentation. So I learned a joke yesterday from one of my soccer players, and I promised her, believe it or not, I promised her I would share it. So here it goes. So this is just good timing, Jack. Thank you. So why isn't our noses 12 inches long? Because it'd be a foot. Mark got it. You made a little girl's day.
I have grandchildren, so.
Oh, yeah.
So, I have a question.
Questions, yes.
On these daily cash reconciliations, but
yes,
you know, when you say that, I visualize somebody with a bank statement and a pen checking off, entries. But I assume you have computerized reconciliations, and do they just pop up if something doesn't fly? And so would you just sort of say it doesn't reconcile today, and it tells you? Is that how, you know?
You're talking to the right guy, because I actually designed our daily reconciliation of cash. So in a way, we have, a bunch of accounts that with individual DDA that we reconcile. We call them MU accounts at State Street. And we have individual funds on Savers that we're able to track those accounts on. So we will daily make entries into those Savers accounts, and at the end of the day or the next morning, we can verify whether or not those entries match State Street's ending cash balance. Usually STIF is the cash equivalent that we'll use sometimes, and we also check real cash and GDMXX, which is another vehicle that State Street offers.
Are you just looking at the two numbers to see what they're saying?
No, yeah, we look at the two numbers. There's 40 lines that we're checking every day, and whenever we have an offage, I will let the accountant know, and the accountant will let investment staff or they'll, if it's an error, they'll fix it. So depending on the situation, it will be rectified. But it's daily. It's not. We used to have basically monthly cash reconciliation, so we'd have an offage at the end of the month, and then we'd have to kind of dig through the daily to find it. But now, because of CAP and the individual funds that we set up on Savers, we're able to reconcile cash daily and have everybody aware of whenever there's an offage there. So, and it helps clean up a lot of issues when it comes to reconciling.
Okay.
Frank, from the board's point of view, so high level, what should we be looking for in the accounting department to make sure everything is going okay?
I would say have a strong understanding of the internal control policy. I think and we recently had a really good update, and I think it really improved our internal controls, but if you have an understanding of how cash is being monitored through that policy, then you'll know that we have strong redundant controls in place. We have separation of duties. We have investment staff initiating, accounting staff processing. We're not enmeshing the two and running into a situation where you can have independent issues. But we have a really strong internal control policy. So I would say there really isn't any areas that I'm aware of right now, but I would just encourage everyone to get a good understanding of that policy. And I'm sure everybody does.
Thank you. Anybody else?
I have a quick question. I was a little bit surprised that we were not that long ago doing a manual fax transaction. Is there anything else that is maybe not being processed as efficiently as it could be if we were to have whatever we need to make those transactions? Fewer manual steps?
Potentially, I think it takes time to implement those types of things because a lot of initiation happens on the investment staff side. So could we potentially use that same platform to have other investments requested on those platforms to the accounting staff? Potentially, yes. We're actually looking into a few of those things, but it takes time to implement them. It takes time to really vet them out and talk. But it's all incremental. I think every day we're always looking at things where we can improve our efficiency, especially with processing. But we have Mike on staff who's a huge benefit when it comes to making our operations more efficient. So yeah, there's a couple other items I'd like to bring up, but I don't want to get ahead of my skis here on a few things. So potentially, yes.
And you're working on it?
Yes, absolutely.
All right, I'll go next. I'm Kendra Cozy, and I am the manager of daily operations section. So he kind of mentioned my group. I work in state accounting. Daily operations section is probably a new term. It used to be treasury and warrant writer unit, but we've kind of merged those two units into one. So I'll kind of talk about what we do as a group. We are responsible for monitoring and reconciling all treasury bank accounts. The biggest one, of course, is our main account at US Bank. That is a daily/monthly process. And I'll kind of add to what he said. So we do Some of it is auto-reconciled, so our system has a way of matching up the transactions, but there are several that we have to manually reconcile, but we are working on making that more efficient as well. He mentioned, but we notify BOI of incoming and outgoing estimated amounts and any large dollar amounts that we become aware of for investing purposes. We do outgoing wire transfers, mostly for universities. And then I'll give you some stats for formerly the treasury side of our operation. We get monthly deposits ranging from $400 million to $600 million. In fiscal year 17, there were about 68,000 transactions in the main account. In fiscal year 18, there are around 73,000. Like I said, we started working on increasing the efficiency of our reconciling, mainly to become more auto-reconciling. We do have some of that now, but we're working on getting some more, just so it's less manual. We're also looking to review all of the outside banks, so all the banks in areas where US Bank wasn't an option, to see if now it might be because of increased technology, increased use of our OED machines. If any of you were here at the last meeting, I wasn't, but Neil had talked about our plan to implement the OED machines, which are the check scanning machines, and we have pretty much completed that plan. We no longer take checks in our office. We do still accept cash, but our daily deposit amounts used to be in the millions, and now it's averaging around $2,000 per day. With the use of the OED machines, the money is getting into the bank one day earlier as well, so it's helped with the investment side of things. And then the other side of my unit is responsible for payment and supplier maintenance. This includes reissued payments, stale date payments, ACH returns, and foreign payments. We also do the state 1099 miscellaneous and 1042 IRS reporting every year. We do approximately 2.5 million payments a year out of the state AP Saver system. About 72% of them are ACH, and that continues to grow, so that helps with internal controls as well. We've reduced the use of paper forms and automated some of our processes to be in our system, which has decreased some of the manual work and the paperwork that used to go into maintaining the suppliers and the payments. We are currently working on automating our 1099 correction process, which is all manual right now. So we're hoping that that will be completed before we begin our correction process this year. And then I'll quickly talk about some of our fraud mitigation efforts. We, this year, switched over to new check stock. So it now contains a colored seal and has some other security features that were not included on our old check stock. We've seen kind of an influx of some fraudulent checks over the last couple of months, so we've been working with law enforcement, and actually the FBI's kind of gotten involved. So we're working on that. And then we also this year completed our disaster recovery plan. Used to be that in the case of an emergency, we would be able to print our checks at U of M. And then they discontinued printing checks and started using print and mail. So we have worked with US Bank, and we are now able to print our checks at US Bank in the case of an emergency. So we've tested it once, we'll be testing it again in October. So we'll continually test, but in the event of emergency, we just have to get into Sabres, and there's just a checkbox that we check, and our file will go to US Bank to print our checks. That's all I have, unless anyone has questions.
Jack, how would you characterize your relationship with Board of Investment?
We work with them daily, especially, every day we give them an amount of any incoming or outgoing amounts
Not so much that, but I mean, do you think our relationship is good? You work well together, that kind of thing?
I think so. I mean, I've only been in my position for a year and a half, so I might not be the best person to speak on it, but from what I've seen, I think so, yeah.
Can we do things more efficiently? Do we help you, or
You know, we
some
kind of,
obvious inefficiencies in the system that we need to
I think
address?
there's some room for maybe just transfer of knowledge. I know we kind of met before this meeting, and there were just some things that were brought up that maybe you guys weren't aware of that US Bank does, some things that US Bank does, and even we weren't aware of it. So maybe just some transfer of knowledge might be beneficial.
Okay, thank you very much. I just want to know about this auto reconciliation. Is that something that we can use, or that we should be using, that you're using? I mean...
It works through Savers, so I don't know, it's probably pretty different.
Files between Savers, which is the state financial system, and US Bank, where the individual transactions are taking place. So there's a file that transmits the data back and forth. I would imagine you could have a similar situation with State Bank, but I don't know.
So we are, sorry.
Oh, you're fine.
For something that we can look into, and we're currently in this process, is aligning our accounts, our Savers accounts, with State Street's accounts as well. And so we can utilize that same type of tool and technology for our reconciliation with State Street. Right now, they're not one-to-one, but in the future, hopefully in the near future, we'll have that aligned and we'll get some efficiencies built into the system, but it's a work in process for sure.
It would seem like if you got, it just seems like the more you can take the manual comparison out of the process, assuming you don't have a glitch in your, auto reconciliation program, the better off you're going to be, right?
Yes, absolutely. There's just a lot of infrastructure to build into that. The general ledgers at State Street, we have a lot of them. And we have to align every single one of them, and it's an individual ledger to ledger to ledger to ledger right down the line. So we have, like for example, we have 30 CAP reconciliations. That's 30 GLs. That's 30 accounts with those 30 funds with separate accounts. And we have to align every single one of them. It's doable. It's going to take some time, and it's worth it because it will be significantly more efficient than what we currently have. But we've had some headwinds with CAP being integrated, and some other projects have been getting in the way of that one. So status quo has been working, so we've been maintaining the status quo. Yeah.
Mark, I would add to that, maybe to your point, is we're not sitting there like with a printout from State Street and a printout from Savers going, where's that transaction? A lot of that is automated through tools like Excel, and we know where those transactions should flow, and the reconciliations are built so that, we're comparing, this is where we expected it to go. So it's the anomalies that fall out. We are not physically taking a bank statement and looking.
So it's more the bottom line than it is each entry. And
correct. Yes. So I just wanted to kind of provide that a little bit.
I couldn't visualize doing 30 accounts every day with. I couldn't do it.
Oh, it's a monthly, and we have an awesome staff that's able to process those by the end of the month because they're monthly reconciliations, and we've had quite a bit of work in building an infrastructure that is somewhat automated. I would say it's a hybrid because we have to map the two accounts now together, and so it just, when you map it out, it ends up working. The problem is that we have 30 different maps. We'd like to get one map.
So can I go back to your question? So in reality, because this is what I did for 29 years, if you don't reconcile, then you go look for it.
Yes.
The two numbers are the same, Yahoo, out the drawer. I mean, that's the reality of it, right?
Right,
Okay,
absolutely.
good, because I'm thinking, this should not take up your whole life.
No.
What takes up your life is if you don't reconcile.
Right.
Hopefully you guys are so good that
Yes.
every time.
We have an excellent staff and they rarely get reconciling issues, for sure.
Okay, thanks.
Mr. Chairman, I would just wanted to go through the mechanics of how we manage the actual dollars in the checking account. So we're trying to manage the amount in the checking account so that there's not so much that we're foregoing investment earnings or in an extreme case, causing a charge to post collateral to the balance. But we don't want, but the key is we don't want to go below zero because, well, we do.
That's not good.
We do have overdraft protection, but it is expensive and the amount is uncertain and the process is uncertain. Uncertain in the sense that the U.S. Bank does not expressly give us the amount that of overdraft protection that is authorized locally, where they would have to say, well, we're going to have to get a second authorization on it. So it makes it difficult for us to think about ever going below zero. So right now we're targeting a inter-day collected balance of about $5 million in the checking account. So the thought process is that occasionally we call you the treasurer's office. I know that's we'll say, hey, we had a request for a wire from a particular agency. Maybe it's even one of the colleges. We want to be able to honor that and let the wire go through. So that could be as much as several $1 million. And that could happen later in the day. And so we would have enough money to cover that. So to project how we're going to maintain that balance, the process begins the day before in the afternoon. We accumulate the information from the treasurer's office where they will send us a spreadsheet with the information that they know so far in regards to ACH, automated clearinghouse transactions going both out and coming in, as well as expected wires out and in, deposits that they expect, and warrants or checks, although checks have become a much smaller portion of the balance. So then we also get information from State Street, our custodial bank, and that information is generally how much securities are expected to mature, income, transaction settlements, and so we use that to estimate what the net from State Street is going to be. We're also looking at the U.S. Bank ending day amount for this day to project the opening amount for tomorrow. Then also occasionally we'll have information from other agencies and internally. So for instance, the Office of Public Instruction will send out between 45 and up to 100 million on a particular day. The pensions will, between them, send out close to 60 million on a day. So we want to make sure that we have that information, and those dates don't change. We know when those days are going to happen, so that's not a surprise. But we're still looking each day to make sure we know when that's going out. So we use that information, throw it into a spreadsheet. Say the minimum is 5 million, so we expect tomorrow that we're going to be able to spend X dollars, invest X dollars. So anything that we don't invest remains in the checking account. So then the next morning, we begin trading. Usually starts, we usually trade between 6:30 and 8:30 for purposes of STIP and cash management. Since the fixed income team got laptops, though, we can actually trade from home, and we'll trade as early as a 5:45 in the morning. And the reason we would do that, well, because of supply and demand. The good stuff comes out early, and we'll try and get it when we can.
So we got day traders now?
Well, everyday traders. So yeah, morning, day, and night. Then we just in regards to the amount of trading that we're doing, and it's a pretty significant effort. In the trailing 12 months ended last quarter, we did a little over 11,000 trades, 1,100 trades in excess of $26 billion. So it's a pretty significant effort. Every one of those trades has to be authorized by Tim or Mike, or the operations team has to authorize all of those trades, and then accounting has to book and do whatever they do with the trades, process the trades. So
whatever.
But it's a lot of effort, if they tell me, and I wholly believe.
Nice recovery.
This is why he has to buy donuts every once in a while.
Right. It's a one-way relationship. All they can do is make my life easier, and all I can do is make their life harder. There's nothing I can do to make their life better, but I buy donuts occasionally. And we really do appreciate their efforts. We really do. So around 7:30 in the morning, we will go out to the U.S. Bank, the DDA account, and check the actual balance. Up until that point, we are running on projected numbers. Again, the reason we do that is because we want to trade before that number is available. Once that number is available, we'll adjust our available investable funds and trade accordingly. After we're done trading, we kind of going back to what Diane was asking. After we're done trading, we print tickets, we sign them, we walk them over to accounting, give them to Kelsey usually, and I believe Kelsey then scans them and stores them electronically. So yeah, maybe there's some efficiencies that can be gained there, but we also have some system operate issues that we'll have to work through there. So then, all of that gets netted out, and we have either a wire in or a wire out of the checking account to or from State Street. And as Frank mentioned, that generally happens right around 10 o'clock. After that, if there's no other issues, then we're done with cash management until we do the projections in the afternoon. So kind of a big if there's no other problems. Well, the problems could be failed trades. That's an issue where you thought you were getting a maturity date, it might not have happened. You thought that you were going to fund a settlement, that might not have happened. So kind of a significant weakness in the whole process is that wire. So right now, that's the only way that money comes into or out of the checking account. But if you've got a negative balance, you're more worried about money coming into the checking account. So the one thing that we've done in the past couple of years is that, okay, well, we're going to actually custody some securities at US Bank. So that if we either buy or sell a security, it comes directly out of the checking account, not through a wire. And so right now we have about $50 million of treasuries at custody at US Bank. So that in worst case scenario, we can sell those treasuries, they will automatically become available for expending funds. 50 million, why? Because that would about cover pension payments. And that's the one thing, at least I don't want to do, is bounce pension checks.
So those are treasuries that are actually held at the bank?
They're custodied at the bank.
Custody at the bank, but you still have control over the bank?
Yep. So we still do the transactions, we still book the transactions so that they show up on our, they do show up at State Street. It's just that they show up for accounting, not for custody purposes.
And then how long does it take you if you needed to sell them?
Minutes.
John, this is Kim. May I add just a little bit of flavor as well when we're talking a bit about perhaps if there's an unexpected large wire that goes out, that type of a thing. We have got, as John had mentioned, there are lines or there are, we've got practices in place that we're certainly able and very willing to work with the state of Montana on, and we've done so. The primary reason that we don't typically share the amounts of what we may have in mind for the states is because it could be construed as a loan. So we certainly have got some guidelines. If there is an emergency and perhaps it was 20 million or 50 million, we will certainly work to accommodate the state. What I have shared is it can take just a bit longer depending on the dollar amount and the approval level that is required, to work on getting those wires or ACHs approved and sent out. But certainly something that we have always been able to work with the state on.
Thanks, Kim.
Thank you. So is the fact that the bank has these treasuries in their custody also facilitate their willingness to cover the deficit, or are they entirely separate issues?
Well, I'll give you my perspective and then let Kim comment on that. But so they are not pledged as collateral, for instance, for a repurchase facility. So I don't believe that there is any legal ability for US Bank to seize that collateral, and so putting words in Kim's mouth, and she'll correct me, I don't think it does add to or help facilitate that.
And you're exactly right, John. This has been in place for, I don't recall, maybe the last couple of years. And prior to that, we have always, worked with the state of Montana and will continue to do so. So this was just another vehicle, kind of another option that helped in the event that, that there was a mishap or perhaps there was some funding that was either sent out or they weren't aware of. So, but no, we've worked with the state of Montana for well over 30 plus years, have a great relationship, and we'll certainly continue to work with them with any kind of a situation that may arise.
So there must be some sort of contractual arrangement that covers that advance when it's necessary, like in a ready reserve, analogous to a ready reserve account for, say, my account. Is that true? I mean, I imagine there's $20 million worth of cash that's going to be lent without a paper trail, so.
Well, in most instances, what they would look at doing is, let's say that they would have a timing issue and there could be a daylight overdraft. If those monies need to be sent out prior to, let's say, the funding of the State Street wire coming in, we will release those, and there is not, there is not a fee that we have assigned to that because it's basically taken care of within the same day. In the instance that there is a negative collected, so they're using funds that have perhaps not been collected upon, there is a contractual rate for that. And I'm sorry, off of the top of my head, I do believe that it's prime plus 2 would be that rate.
So you know, you have the ability to know when it's covered, I mean, that it is covered, because you know that transaction's coming in. Is that right?
If there is an instance, John and I have always communicated, and I'll get a hold of him and say we've got a daylight overdraft. He always lets me know. You know what? We've got a State Street wire coming in. So yes, we've always got a very good idea, and never has there been an instance that we have anticipated that a wire should be coming from State Street and it has not. So that has never been an instance.
Refreshing to know.
So, just one more question. So, John, your biggest nightmare would be being retirement checks going out and having an issue and a FUPA where you're not. Why wouldn't you just have it set up so that it triggers? So you don't. Somebody doesn't have to go up the pecking order at U.S. Bank. Why wouldn't that just be something? Because what I'm hearing is kind of, well, we pretty much have this covered, it never happens, but if it did, we can go this high, and if we needed to go higher, we almost sure we can do that. But why not just make it a non-issue by having the collateral pledged and the document signed so you created the money?
A couple of things. Pledging the collateral could be prohibitively expensive. The state would have to, and I believe contractually would actually, the Department of Administration would have to pay the fee for the collateral. So if we wanted that always available, it'd probably be prohibitively expensive. Then the other thing would be that the charge for the overdraft, the prime plus 2, it would be kind of prohibitively expensive. You have to look at that vis-a-vis the amount of earnings that you make on the treasuries at U.S. Bank. And while each individual treasury maybe earns a little lower rate than STIP because we're buying further out, 90 days. Right now we're buying treasuries in that account that are earning well in excess of 2%, so that is not prohibitively expensive, and so, but the gist of it is I don't think we have had the issue proved where there was a significant overdraft and it was protected, and I don't feel comfortable relying on only that to cover pension payments.
This notion of a daylight overdraft, how often does that occur?
Well, regularly. First of all, I'm going to answer, and then hopefully my answer is really what a daylight overdraft is. So, for instance, if we have pension payments or a large OPI payment going out, that goes out of the checking account as an ACH first thing in the morning. So when I go out to the U.S. Bank account, we might see a negative current day balance in excess of $50 million, 50, 60, 70 million dollars. So that regularly happens. And then we plan to cover that with the wire in from State Street. So it happens at least twice a month, probably more, because pension and OPI payments go out once a month. So at least twice a month and likely more.
So on those big days, right?
Yep.
You direct. Why is there a lag between? Why isn't the money coming from State Street the day before?
Well, because then we would not get the earnings of it. And we might have to, if it were, I'm putting words in Kim's mouth, but if it were over the 75 million, 80 million, then it could cause a collateral charge.
Oh, okay.
And so I worked with John probably about a year or so ago, and we made some modifications as to what we would call the daylight overdraft line, and I think it's significantly helped. There still may be those occurrences, but it is not an occurrence that is required by me for an approval to release any wires or ACHs. That only happens if it would perhaps be, let's say, over 100 million. So I think, John, you still may see those, but on my end, I don't see those anywhere near the number that we did, say, a year or so ago. So those wires and ACHs are automatically, basically, sent out and released. And again, that's knowing upon the relationship that we've had with the state, and we feel very comfortable with knowing that will be funded. Typically, it's usually funded by 11:30 in the morning, by 11:30 a.m.
And just to add to that real quick, Frank earlier mentioned a new process we have through State Street's cash flow module. And so in the past, that wire was manually instructed to State Street via fax after it was passed around here. And then State Street had to go in and type the wire to the Fed payment system and wire it to U.S. Bank. Whereas now what happens is when we approve that cash movement sheet through State Street's cash flow module, it actually goes electronically from hand to hand, quicker. But when it finally goes back to State Street after state accounting's final approval, it feeds right into the wire payment system and gets released. So it's all the manual touch points have reduced the time that it takes for State Street to get the money out. So the daylight overdraft period between the time the ACH goes out and the money comes back in from State Street has been significantly reduced too.
What about John, you said that, on the OPI and the pension fund dates, the big days, we have these. What about non-big days?
So that happens where we have a negative interday balance. It happens regularly, and that is because the amount of bills the state pays fluctuates fairly significantly. And we're targeting $5 million during the day. That's the beginning. I should say that plus anything that came in after the State Street wire as the beginning of the next day. But we might find out at 3:30, 3:45 that there's 22 million of ACHs going out and only 5 million coming in. So that's going to start off with a negative balance in the checking account in the morning, following morning.
And Carl, to your point, both the Board of Investments and the Department of Administration have asked agencies to let us know when they have large transactions in a route. Some agencies are very good about that notification, and other agencies are not.
We should put Kendra on that. Thank you.
I think one thing the board needs to know, we're in a good cycle relative to the state of Montana. Last October, there were literally questions about whether or not we got cash from any payroll. So we have come a very long way from that. I think there will be questions next legislative session, which we may have to answer about whether or not the treasurer's cash account is something you can just go in and utilize. But I don't think a lot of people understand that those dollars belong to someone. It's not just a bucket of money, it is a bucket of money assigned to certain elements within the state. So BOI, DMA, we got OPI to behave themselves. Did a very good job last year, especially in those crisis moments. So as I hear these daylight shortfalls,
transactional, handles itself very well. We're making money overnight on that money as opposed to having it sit idle. But in the pinch, we did very, very well.
Anything else? Thanks for having us. Thank you very much. Thank you, Kim.
Thank you.
Thank you.
Take a 10-minute break or so.
Okay.
Okay. Mark, you are on.
Great. Well, I'll try to be fast so we can get out of here on time at 4 o'clock, and it should be able to do that. If you turn to tab 3, there's a presentation that will be going off of. For the education session today.
Tab 8.
I always have the wrong tab. Mine's in tab 3, but I guess mine's in tab 8. I don't know how that happened. Sorry about that.
But we finished 3, I'm ready to go.
Trying to get you out of here.
Good job.
So this presentation largely took shape. We, as you know, we had 4 board members to the Portland offices at the end of August, and we used them to provide feedback on what was particularly helpful, regardless of whether you're new or an existing board member. So we assembled a few topics. The first is just to rehash performance reporting basics. We go over every quarter a lot of different metrics. Sometimes even we take for granted what they mean. So, you know, it is worthwhile to just kind of go over some of the metrics that we provide and how they tie into your objectives in terms of your investments. The second thing is just discussing some of the board member challenges that we commonly see. We've done quite a bit of research on this, and also some tactics that you can use and you actually do use in order to make effective decisions at your meetings. And then finally, this is kind of a fun part, at least from my perspective, just a review of some of, as investors, as board members, one of the most difficult things that you deal with is a lot of our instincts as human beings often lead you to make decisions that are not in your best interest. And we're just going to review some of these so you can be wary of those when they occur. We actually did a pretty interesting exercise. Well, we don't have time to do it, but a lot of the board members were there with some pretty interesting results, and we can talk about that.
Who failed?
It wasn't that's what everyone was asking. It genuinely wasn't a test. It was it was a test to determine whether there's a bias or not in terms of how things are framed for a decision. And no one individual made a mistake, but in aggregate, people were making different decisions based on a very, very slight change to the way information was presented, which was pretty interesting. So with that, why don't we get started on page 3. So this presentation won't be metaphor heavy, but it will be quote heavy. I found a few good quotes while I was putting this together. To be honest with you, I don't know who Marty Rubin even is, but I thought that was pretty good. Einstein, I didn't know who he was. You'll see that later on. But the quote of every line is perfect length, and if you don't measure it, is a good way to capture performance reporting. It's imperfect. A lot of times we are talking about the imperfections in the metrics that we use, and there's always caveats here and there. But if you don't do anything, or if you do the bare basics, at the end of the day, you're not going to hold yourself accountable, and you're not going to make needed changes to your investment strategy. And that's what we try to get across with this quote. If you turn to page 4, we did want to just review the most important investment terms that you'll hear, just to make sure. And I think for a lot of you, this is going to be repetitive, but just to make sure that when we use these terms, you understand what we're talking about. First is annualized return. Sometimes you'll hear this referred to as geometric versus arithmetic return. Essentially what this is, when you look at the 10-year return for the Montana Board of Investments, I don't remember exactly what it is, but let's call it 5%. That essentially is the return that you've gotten if there was no volatility in the return. So you basically, if there's no volatility, you would have gotten 5% every year based on the investment returns that came in through the door. This is different in a volatile environment. This is different than an annualized return. An annualized return would be if you just took every 1 year return, added them up, and divided by 10. And the reason that's different than a geometric return is just basic math. So if you have a return, let's say, take an extreme example, let's say you start out with $100. The first year return is negative 50%, you go down to $50. The next year return is plus 50%, you go up to $75. The average return is 0, but obviously because that 50% gain is coming off a smaller base, volatility reduces your return. And that's why the annualized return really is the most important metric that you look at when you look at your performance. Why don't I pause there? Any questions on that? Great. The next two are pretty straightforward, gross of fees and net of fees, because we use both in your performance report. The most important return is a net of fees performance. This is taking out the costs of, well, to some extent, internal management for the fixed income portfolios, but really the investment manager fees. You are using mostly external managers in areas like U.S. equities, international equity, obviously private equity and real estate. The net of fees is important. You're paying managers when you could, in some cases, invest in an index fund, and you want to know what you're getting after you account for the fees that you're paying. The gross of fees is simply put before those the investment management fees that the managers charge. And the reason that this is important really is because we do look at your performance versus different peer universes, and the way peer universes work is they don't report net of fees, they report gross of fees. So it wouldn't be fair to compare your net of fees performance to a gross of fees universe, so we use your gross of fees performance. Why don't I pause there? Any questions on that? I think those are relatively straightforward, but definitely, okay. The next one is the total fund peer rankings, and we end up talking about those a lot. And they have changed over time. They're actually pretty darn good right now, and you've heard that mentioned several times in meetings. But essentially what we do here is we have access to two databases where a lot of different public funds report their returns on a quarterly basis. This is not just RDK clients, it extends well beyond RDK clients. And we use that to compare how your returns over different time periods compare with that period. Higher is better. So over the past 10 years, you're hovering around top decile, top quartile, depending on the period. That's exactly where you want to be. Even above median is a good place to be. And we'll talk a little more about the limits of this. So these do need to be taken with a grain of salt, particularly over shorter time periods. And we'll get into what we're measuring, some of the different things, some of the different decisions that we're actually measuring with those that are on. Next is standard deviation. Standard deviation is a complex word, I guess, but essentially what this is measuring is the amount of volatility that you're experiencing in your portfolio on an annual period. And the way to think of this, just in terms of numbers, it's a statistical measure that defines how much your expected return is going to vary. So let's take an example of, let's say you have an expected return, or you can look at it historically or going forward as well. But let's say, let's look at it as a projected basis. Let's say you have an expected return for your portfolio of 6% and a standard deviation of 10%. What this means is if you're in terms of one standard deviation, which is essentially 67% of the time, you can expect your return to be either 16%, which is your 6% expected return plus another 10%, or negative 4%, which is your expected return minus 10%. And then you got another standard deviation, so two standard deviations, and it just gets wider. So, and then you essentially have a 95% chance of having a return that falls between 26% and negative 14%. Essentially, it's a statistical measure to give you some sense of how much variance you can expect on a percentage basis for any given year. That may sound a little convoluted, so I want to pause there. Any questions on the standard deviation? All right. The next page talks about a few other metrics. The first is downside risk. If you understand standard deviation, you essentially understand this. What downside risk is looking at your volatility, but only in negative markets. It's something that we've talked about in the past because you do have a portfolio that has less of it than your peers, which is a good thing. So not only are your returns, risk-adjusted returns overall, not only do they look good relative to peers, but you're also having less volatility on the downside, which can be some of the scarier moments when you're overseeing a portfolio like this. The next metric is correlation. This is really a fundamental underpinning of diversification. Correlation is essentially, without getting into the formula, which you actually find at the end of this presentation, what correlation measures is the degree to which it can be different specific investments, or mostly what we use it in the context of asset allocation, but it measures the degree to which two different investments will move together. So on one end, and it ranges from -1 to 1. So on one extreme, a correlation of 1 would mean that the investments move exactly in the same direction together. A -1 would mean they move in the opposite direction. And 0 means it's just random, that one may go up, one may go down any given year, but there's no pattern to it. And the reason why correlation is important for diversification is because if you diversify your portfolio and you have asset classes that either don't have perfect correlations, have no correlation, maybe even a negative correlation, that will dampen the overall portfolio volatility. And as you rebalance the portfolio, can also increase returns as well, because one goes down, the other goes up. You sell off some of the gains you've made on the asset class that's gone up, rebalance to your target, and then then it can reverse. So it's one of the most important things in terms of asset allocation. If there's perfect correlation in all the asset classes, there's obviously less value to diversification. The next metric is we use this less frequently, but it's another metric that measures your diversification in the portfolio, particularly with regard to its relation to equity markets. Portfolio beta essentially measures the sensitivity of different asset classes to equity markets. As you know, the volatility that you experience and the risk that you experience in the portfolio is largely centered on equity markets, and having asset classes with less sensitivity, like private equity and real estate, can dampen that overall sensitivity to the portfolio. And you've seen that chart many times where we show the lines of historical beta for the different asset classes, and the fact that your overall portfolio, despite a very relatively high equity allocation, is running at a beta around 0.6, I believe, is maybe a little less than 0.6. Tracking error, if you understand standard deviation, you essentially understand this. Tracking error is a metric that looks at the standard deviation of a manager's return versus their benchmark return. And the reason why this is important is the more tracking error that you get, whether it's at the manager level or even at the composite level, the more, particularly over short periods of time, you can expect some outperformance versus the benchmark or underperformance versus the benchmark. Probably mainly used by staff in terms of investment managers, but it's also something we've mentioned several times at the composite level. And then finally, Sharpe ratio. You've heard us mention this a lot. This is it's actually a relatively simple formula, but essentially it's a measure of risk-adjusted returns. Essentially, a Sharpe ratio is the return of an investment minus the risk-free rate. So depending on some type of treasury return, and then divided by the volatility of the standard deviation of the portfolio. So essentially, without thinking through the math of it too much, you're essentially measuring how much additional return have you gotten versus a risk-free rate where there is risk, but the treasuries are the least risky asset out there. How much return over that are you getting for the amount of volatility that you're taking on by doing that?
So is it the number of standard deviations that the return is from a risk-free?
No, it's just the standard deviation of the portfolio. So it's not the standard deviation minus the.
Okay.
Read that a few more times. Yeah, I mean, the formulas are in the back. Essentially, you're looking at the volatility of your investment portfolio. You're figuring out how much return. You have to use a long period of time here. Over a long period of time, how much return you've gotten in addition to the risk-free rate for taking on that volatility. The higher, the better. So, if you have a 10% return and the risk-free rate, let's say, is 2%, so that yields 8% in the numerator, and your volatility was really low, let's say 4%, right? And that's really low. It's going to be more. It's going to be lower than you've generally experienced, but that's going to produce a very high Sharpe ratio. But on the flip side, if let's say you only get a 3% return and the risk-free rate is 2%, so you get a little premium over the risk-free rate, and you have 15% volatility, that Sharpe ratio is going to be low, and it indicates you're not really getting paid for a lot of volatility that you're taking on. Okay. I'll try to speed things up a little bit. If you go to page 6, what are the MBO, the Montana Board of Investments core investment objectives? The key thing for when you look at these metrics, and we'll map them pretty soon, is what are your investment objectives to begin with, and how are these metrics shedding light on that? We had isolated pretty much 5. I'm sure there are things out there that we didn't include, but at a very high level, we look at these as the main objectives. The first, obviously, is over a long investment horizon to generate a return to the extent that you can, considering risk and liquidity needs as well, that matches the required actuarial return for the plans, for the retirement, for the defined benefit plans. Right now, depending on the plan, it's 7.5% or 7.65%. So in an ideal world, you're matching that or exceeding that over a long investment horizon, and the funded status is not deteriorating as a result, provided that the contributions are on target. The second thing is to diversify. That's actually stated in your mandate. While it would be tempting, given the last 9 years return, to wish you had everything in U.S. equities, at the end of the day, that's not, that doesn't meet the risk objectives that you have, the liquidity needs that you have, and you need to diversify the portfolio in addition to shooting for that target return. The third thing is, which is termed as strategic asset allocation value added. We do look at the asset allocation every year. We work with staff. We look at valuations, expected returns of different asset classes, and it's not just scattershot approach to asset allocation. You are trying to add some value by allocating in a way that's appropriate for the long term. Fourth thing is active manager value added. So you do in your portfolio use active managers. The objective is you do pay higher fees with that. The objective is to hire managers that have an edge in the market and to generate a return in excess of the benchmarks to which they're targeting. And then the last is there is a need to maintain adequate liquidity. In simple terms, it's looking at the cash balance, but it's also doing things like basic studies to make sure that you have adequate liquidity to meet the asset allocation targets that you're shooting for. In terms of performance reporting, what we tried to do on page 7 is just map some of the objectives that you're seeking to achieve to some of the performance metrics that shed light on that. None of these are perfect, and we'll talk about some of the limitations, but just going down the list in terms of the actuarial required return is pretty simple, and looking over as long as you can go, 10 years, 15 years, are you generating, or have you generated a return that, that is close to matching the actuarially, I always mess up saying that, required return of your retirement plans. The second, maintain appropriate diversification. This was a little tough to quantify, to be honest with you, which is another theme and another limitation we'll talk about. But one thing we do look at to measure your diversification is your beta and your relationship to equities. And outside of the performance reporting, I would say the diversification is most often addressed with the asset allocation reviews that staff and RDK assist with. The third thing, strategic asset allocation value added. This is a very difficult thing to measure. We'll mention some of the limitations, but one thing that does help shed light on this is the peer rankings. So if you look at your performance versus peers, a big driver of that is your U.S. equity allocation, your absence of hedge funds, and your private equity allocation. So as strategic asset allocation decisions that you've made for a long period of time do show up in those peer rankings. So we do use those often to, it shows other things as well, but to comment on the effectiveness of your strategic asset allocation over time. Fourth thing is active manager value added. The way the performance metrics to look at there are looking at your asset class composite returns. Are you choosing managers that are enabling you to outperform passive benchmarks over a long period of time? This is more relevant in traditional asset classes. And then it's always used in terms of investment manager returns. Looking at managers, are they outperforming their indexes, both on an absolute and risk-adjusted basis. And as you know, staff is regularly making higher or buyer decisions based on this. But not just this. I mean, there's a lot of qualitative that goes into it as well. And then finally, maintaining adequate liquidity, and the metrics we use there are just, the cash allocation, is it sufficient? And I know we talked about that in past meetings. We also, outside the performance reporting structure, we're looking at basic studies. So, pause real quickly. Any questions? Good. Moving on to page 8, a few more quotes there. But the major points that we want to make is starting with the first quote from Albert Einstein. I thought this was kind of crafty. Not everything that can be counted counts, and not everything that counts can be counted. It is important to understand, and we reinforce this a lot, that reports don't capture everything that you need to be concerned with as board members. And I can assure you not everything in that 150-page book that we send you is equally important. Understanding the high level is what's most important, and understanding that not everything that's important can be quantified. And which gets to the next quote, and similar to the first quote, I don't know who this person is, but I liked what they had to say. We tend to overvalue the things we can measure and undervalue the things we cannot. There is a temptation in the performance report just to focus on the numbers, and as you know, questioning staff, there's often a subtle story behind those numbers that can often be more important. So recognizing that just because you can measure it doesn't mean it's the most important way to evaluate a strategy, an investment manager, or a decision that you're making. And then lastly, if this one is on us, if you can't explain it simply, you don't understand it well enough. We spend a lot of time trying to figure out how to do it. Ultimately, that's a big part of our job, is to take very complex topics and to explain those in terms that some of you have done this as a profession, some haven't, in a way that everybody can understand. We don't always succeed, and we definitely encourage you. If you don't understand something, everybody here is very smart. If you don't understand it, it's not because you're not smart, it's because we didn't explain it well, and don't feel hesitant to ask us questions and to have us explain it differently. All right, moving along. Some limitations on performance reporting. I'll try to go through this really quickly because I know we've talked about this a lot. The first one is the biggest one, which is time horizon. The typical time horizon that people think in is often very abbreviated compared to the time horizon that is needed to evaluate an investment. And I go back to the real estate investment. this was made in 2006. A lot of people that made that investment or made that decision to invest in real estate are not here. Trust me, it was painful for the first 3 or 4 years of that investment, but it had an important role in the portfolio. You're finally really seeing it now. It took that long. So there is a patience that needs to be exhibited in investing that is often not instinctual, that people need to be aware of. The second thing is, to this point too, is tracking error. We've talked about this, but you will see both positive and negative deviations on all types of investments, and exercising patience and making sure that decisions are based on what is driving that tracking error and whether it's unexpected and acceptable, rather than whether the tracking error simply exists. The third thing is the variance in peer investment objective. We talked about this before. Peer rankings are useful directionally, but at the end of the day, you don't know why other plans have chosen the asset allocation they have. They may have different dynamics in their liabilities. They may have different constraints in terms of asset classes they can invest in. They may have different competitive advantages in terms of what asset classes they know. That needs to be taken with a grain of salt. The other thing is fee structure. You have a low fee plan. When you're slightly low fee, modestly low fee plan relative to other pensions. So when you're comparing gross fees performance, you actually may be understating your performance to some degree, because the fees you end up subtracting are less than the fees that others are subtracting. And then finally, just some plan-specific investment constraints can also affect performance. It doesn't show up quantitatively, but at the end of the day, for instance, you've capped on certain investments your emerging markets exposure in the past. That plays out in terms of your performance, but it's not necessarily captured in the numbers. So there are some things like that that are going to affect your performance as well. So key insights, I'll run through this really quickly on page 10. Performance reports, they, despite their limitations, do provide a very critical check on the effectiveness of an investment strategy. We do our best to understand your objectives and link those metrics to those objectives, and also explain those as clearly as we can. But it is tough, and it is an imperfect practice. Thirdly, performance reports are definitely not the only source of information that you should use to evaluate the effectiveness of your program. Similar, and I'm sure staff can tell you, the numbers are not at all the only thing that goes into investment or evaluating an investment manager. There can be an outperforming manager that you terminate for a good reason, and there can be an underperforming manager that you don't terminate for a good reason. There is a lot more than just the numbers. And then finally, clarity is our responsibility. If we're not giving it, let us know. All right, so why don't we go to the board member challenges. So a lot of the time that we spent going to page 12, a lot of the time that we spent in the orientation was talking about the responsibilities of the board members. And we used rather than coming up with this on our own, we used your own words to describe your responsibilities. You can see that on page 12. You have responsibilities beyond the Unified Investment Program, but in terms of our relationship working with you, it's all focused on the investment program. And some of the specifics here, discharging duties with care, skill, prudence, and diligence, diversifying holdings, and discharging duties solely in the interest of the benefit of the funds managed are things we talk about constantly and have talked about previously in our review of some performance metrics. In terms of just some more specifics, obviously you have a lot of oversight responsibilities that were not covered on the website, things like hiring an executive director and CIO are obviously core responsibilities of the board. But the things that we repeatedly deal with are reviewing and approving investment policies, looking at the asset allocation and approving ranges every year, and then with a wide variety of specifics, looking at the investment activity of the board and the staff each quarter and asking good questions as to why a certain strategy or certain decision is being made. So if you turn to page 14, and I've mentioned this to people before, the hardest thing that we deal with is is in working with boards is the dynamics of the boards. I would say that you're definitely on the easy end, but it is a challenge that you have a lot of, which we'll talk about, you have a lot of factors that make it very difficult to understand your scope of responsibilities, understanding the data that influences the decisions that you make, and also just preparing and executing at meetings. Realizing this, we actually did a pretty extensive study about 4 years ago where we reviewed all the literature out there, which was largely opinion, interviewed, and Mark was one of those, your chairman was one of those, interviewed about 35 different investment committees / boards. We usually call them investment committees, but obviously you're an investment board. And then conducted a couple surveys. And our goal was to essentially understand what are the biggest challenges that can lead boards or committees in the wrong direction, and what are just some kind of good disciplines and effective practices for resolving those challenges. And if you want, this study is available. It's about 60 pages. If I'm not making you tired enough right now, this will definitely put you but it's actually pretty useful to get an understanding of what are all the different challenges that you're going to encounter, and what are just some useful tactics to address it. Page 15 covers that. I'm not going to go through all of these different columns. We did narrow it down to 4 basic things that we see: getting the scope of authority right, selecting committee members and creating an effective body of committee members, maintaining strategic continuity. It's a huge challenge as there's frequent turnover on committees. And then finally, optimizing decision-making and execution. We're going to focus on this today just because it sort of relates to the behavioral biases, which I think are fun to talk about. And it's also just a huge challenge that I'm sure you experience. You have a lot of structural challenges that make preparation for meetings and decision-making difficult. It's tough to prioritize what's the most important topic that you need to discuss. Getting clear and usable materials that you can review before a meeting. As I mentioned, 80%, 90% of the work that we do is preparing for meetings. And if you do it well, you only need that final 10% to make a good decision. There is attendance. That's not an issue with this board, but you'd be surprised. We interviewed one endowment where very well-known institution, well-regarded institution, a lot of smart people on the board that couldn't get anyone to show up. And that is a huge problem. So there's a tactic. We actually didn't use it here because it's not really relevant to this group. But there are a lot of structural challenges that you deal with. We dug into this a little more on this page. I'm not going to go through everything, but what we tried to show on this page is on the left, what is it about investment decisions that make them so tough? You have very difficult concepts to understand. You have a lot of uncertainty, even to us, regarding what the right decision is. Looking at the macroeconomic environment, looking at investment managers, you're ultimately making a bet. If you get it right 70% of the time, you're doing a fantastic job. But often you're going to get it wrong. There's very little certainty in this industry. Variable levels of engagement, again, that's probably less of an issue with this board, but endowments in particular is a huge issue. And then lastly, we'll get into this with the behavioral biases, is your human instincts are often, they've been evolved over, 200,000 years for a very specific survival purpose. They haven't really fully evolved probably in terms of making intellectual, ambiguous investment decisions, and a lot of times they can lead you astray. And then you combine that with you have significant competing demands on your time. You're only here for in total about 10 days a year, making some pretty big decisions. So that is a big constraint. And the results can be being tempted to make decisions that are maybe not optimal for the plan. It can be the case that there's insufficient investment in self-education and preparation for board meetings, a lot of challenges that you have before you can get into the room. On page 17, we highlight some tactics that we use in order to help you with decision making. I know they sound like small things, but again, decisions are best if kind of 80% to 90% of the work is done before you get in the room. And we spend a considerable amount of time preparing before meetings to present material in a way that's going to be most helpful to you. Also, we regularly do with Joe and David in the past, and we'll do it with Dan in the future. Just discussing the entire agenda, what we intend to present, some issues that may be contentious, and how do we address those. But handling that in pre-meeting calls, so no one's surprised when they get in the room, has been a useful exercise. Something that's not necessarily visible to you, but I can assure you it's actually a pretty good discipline to do something like that. The next thing is executive summaries. You get overloaded with binders full of 500 pages, and we have found it very useful to provide 3 or 4 pages that provide you 80% of what you need to know prior to the meeting. So even if you have 10 or 15 minutes, you can get 80% of what you need to know in order to make a good decision. And then the last thing is, we have this presented in our paper, but just a couple of frameworks that you can use to prioritize decisions. There's one interesting one that we have profiled where there's essentially a 2x2 matrix with is it strategically important, yes or no, and sounds weird, but is it knowable or unknowable? And this is a framework that a pretty well-regarded investor uses. And the reason for the knowable, unknowable, first of all, you should be focused on things that are strategically important, obviously. But if it's knowable, it's something that you can kind of delegate to, if you're uncertain about a fee structure or something that's very knowable, something you can delegate, probably not worth a lot of board member time. If it's unknowable, whether you want to make a allocation to diversified strategies, whether maybe anything else offhand. Well, how you want to size the real estate investment, things like that. There is no right answer, and that is worthy of debate of the pros and cons of making that decision. So an interesting way to look at it. We have a couple other frameworks that we profiled in the paper that are just kind of useful to constantly be thinking through in terms of are we focusing on the right strategic things. So key insights from this paper. Number one, again, acknowledge the significant time and educational constraints that really impact board decision making, and really the need for us to prepare you, for staff to prepare you, in order to be able to work through some pretty complex topics when it comes to time to make decisions.